So Leonard, you've got 25 minutes, so until 35 minutes past the hour.
Great. Thank you very much, Ian. I'm going to share my slides now. All right, perfect. So thank you for having us present this work. This is a joint paper with Winston Do and Wei Wu from UPenn and Texas A&M, respectively. And let me tell you what motivates this project. So if you think about our asset price models, many of them are cast in the framework of Merton's ICAPM. And that means that they're stylized in the sense that they're kind of neoclassical institution-free models, and the households act as marginal investors, and they directly make all of the decisions. And we typically assume rational expectations for households, and that means that they're responsible for forming sophisticated expectations and making these kind of dynamic, sophisticated plans they need to optimize intertemporally. That's a lot, even in a stylized environment. And of course, in the actual market, complexity is even higher. And because of that, many researchers basically have certain skepticism about how realistic the description is. It's assuming a lot about households, either explicitly or privately. People are basically skeptical about can agents or real investors really behave like that? So there are different ways out of that, right? There is a whole field of behavioral finance where we essentially relax these assumptions. But that is a challenge, right? That a lot of market participants really wouldn't be able to process that much information and also do so much planning dynamically. And the other issue, of course, is that even if households kind of were doing certain things kind of along the lines of what we assume, a lot of the time, or a lot of the assets are managed by institutions, and they have different objectives from the households. And so now, of course, this is getting recognized in the literature. But if you basically think about it, a lot of money flows through these institutions. And if you look at the incentives of the managers, incentives of the fund managers, you could see that they are affected not just by distribution of returns, but also by capital flows. So they're sort of different from the direct incentives of households who would have been optimizing for themselves. And if you look at the empirical numbers, you'll see that volatility of AUM is driven to a significant degree by capital flows in and out of funds. And so what we do in this work is that we basically say that you could make a lot of progress. You could get kind of a lot of the way towards our ICAPM type of results without assuming that households are sophisticated dynamic optimizers, because there is another mechanism. So this is not some kind of abstract invisible hand. They behave as if they optimize. No, we're just saying that, well, households don't need to optimize. They could be pretty unsophisticated. In fact, we assume that they literally don't optimize at all. They're myopic. They just act sort of in a very short-sighted manner. But the optimizing entities are institutions, in this case, mutual funds. And even they are not dynamic, right? They don't have to think forward about how to form these plans. They are myopic. They're myopic, optimizing, and they optimize their own objective. They optimize essentially what they care about, which is AUM. But AUM is affected by capital flows, and capital flows come from households. So our story is about this link. The capital flows provide the link between what households care about and respond to, and what institutions care about, who are ultimately making decisions, allocating capital across stocks. Institutions care about AUM, so they care about capital flow, and that is going to affect their behavior and ultimately get priced into the prices and expected returns of securities. So that's what we're going to do, right? We're going to document behavior of mutual fund managers. We're going to show that they behave as if they care about flows. They are behaving in a way that looks like hedging, capital flow risk. And then we'll show implications of that it shows up in flow hedging in terms of their portfolio choices and also in asset prices and returns. And what obtains as a result, as a matter of theory, is an ICAPM-like relation where it holds even in a myopic environment. So let me summarize the results. So we find that fund flow shocks obey a strong factor structure, and they co-move with macroeconomic shocks. So they reflect, for example, economic uncertainty, how that changes in the economy. We find that exposure of shocks, exposure of stocks to these common flows, which are, we call them flow betas, right? The betas of returns and flows. These betas are priced in the cross-section of returns in the traditional way. They're compensated by differences in expected returns, so they seem to command the risk premium. And we'll talk more about that, but we basically look at how that relates to various firm characteristics, including liquidity, to see that this is really betas priced as opposed to characteristics. And we also find, and that's kind of very important, that fund managers hedge against flow shocks. So it's not just these indirect results that these shocks appear to be priced, but also we have more direct evidence that fund managers are hedging against flow shocks, so they tilt their portfolios away from high flow beta stocks. And that tilt is costly. They pay for that. These high flow beta stocks earn higher returns. They tilt away from them, so they sacrifice some return. And we find evidence for that both in the cross-section of mutual fund holdings and also over time when we look at the changes in exposures. So we look at some quasi-natural experiments. When the fund's exposure to the flow risk changes, we can see how they change their tilt. So that's where we are. Let me quickly outline the model. We're not going to go into any details in this talk. The model is pretty conventional, and by design, it's really simple, because what we want to highlight is that this ICAPM relation can arise in an environment that's really stripped down, where households basically don't look into the future. They don't choose stocks. They just allocate their capital sort of to mutual funds, or they manage it directly. And then the mutual funds, these asset managers, they optimize their own objective. So in our model, it's an equilibrium model. We have three types of actors there. We have direct investors. These are households who don't delegate, and they just manage their portfolio directly, and they're just myopic, essentially mean variance optimizers, single period. And then we have fund clients. These are households who decide to just delegate their asset management to professionals, to the mutual funds. And then we have these active mutual funds. In our model, all the funds are active indices. There is no point, introducing them, but one could. These active fund managers, they care about their own AUM. They are rational, but their horizon is very short, so they are myopic in their behavior. But they're rational, so they understand the whole game. It's just that their objective is different from households. So there is this agency problem. So fund clients, they move money in and out of risky assets, and they create this kind of dynamic stochastic flow into the mutual fund sector. And this flow, of course, responds to the shocks that households are facing. And we model one such shock in the model, which is a change in economic uncertainty. And so the result is, as I said, the fund flow provides a link between the household sector, which is myopic and doesn't properly optimize. And you have mutual funds that are more sophisticated, still not dynamic, still myopic, but more sophisticated, but selfish, and don't care about households directly. And yet they behave as if they do, because they care about flow, and flow provides enough incentive for them to respond to the same shocks that would otherwise matter to the households. So this does look kind of like an invisible hand, right? If households were dynamic, sophisticated, they would hedge in a Merton sense. They would do intertemporal hedging of these uncertainty shocks. Instead, they don't do that. They're myopic. Mutual funds don't care about uncertainty shocks. They basically don't care about households, but uncertainty shocks move flows that they do care about, and they hedge that in an intratemporal, in a kind of myopic sense. And observational, it gives you the same results in terms of asset pricing. So these are the results basically that we're getting. Nothing here is surprising given what I said, that you have a model with a dividend distribution that has a factor structure. You could see here that there is a common shock. And the shock U, that's a systematic shock that affects the factors. And it also affects economic uncertainty, H, right, that moves around. That's kind of a single state variable. And in equilibrium, returns load on these common shocks U. They are affected also by idiosyncratic shocks, asset specific. And if you look at the implications for pricing, what you see is the following, that flows, the unexpected component of flows, they are exposed in equilibrium to the systematic shocks, to this vector of shocks U. And fund managers, they don't hold the tangency portfolio. The reason, of course, is obvious. They don't care about a return on their portfolio exclusively. They also care about flows. They really care about total AUM. So they end up hedging the contribution of the flows to the AUM, and that creates a tilt away from the tangency portfolio. And we show that the tilt is such that they underweigh high flow beta stocks, basically. That's the result. And in equilibrium, if you look at the risk premium on the securities, there is a two-factor structure. The first factor, one could always make it one factor, of course, with an SDF, but you could express it in terms of two factors where the first factor is the market, and the second factor is going to be the mimicking portfolio for flows. So basically, if you look at the risk premium on each asset, there is compensation for the market risk, and then there is compensation for the flow risk. Now, that's a theoretical result. And let's look at some empirical evidence. Basically, as I said, we look at the evidence on pricing, but what's most important here is really this direct evidence on the mechanism that mutual funds, they do seem to be hedging. So our data sources are standard for this literature. We get data on mutual fund performance and their holdings. And we then analyze the distribution of returns in relation to flow betas. Another piece of data that is less common that we use here is data on natural disasters. We'll get to that at the very end. We use this to conduct our quasi-nature experiment. We look at the changes in fund behavior once they're hit by natural disasters, which affect the exposure to the flows. All right. So we construct a measure of flows, and we're looking for the common flows, right? Funds cannot hedge idiosyncratic, unpredictable flows. They can hedge something that is correlated with financial security, so they can hedge the common component. I mean, they can also hedge something fund specific, but that wouldn't be priced, right? So we care about hedging of the common component, something that's going to affect behavior of many mutual funds that's going to show up in prices of securities. So this is what we do. We construct AUM at the fund level, right? And then there is a standard definition of fund flows as the change in AUM, which is not accounted for by the return during the observation period. Now, you immediately run into the following problem that if you want to argue that there are some common shocks driving flows, and these shocks are driven by some macro factors, we don't want that to arise mechanically simply because as a result of how we define the flows, some information from returns creeps in, and these common factors, they're really return factors. So for example, in this definition, we're looking kind of at discrete points in time, right? Like every month you take a measurement of AUM. But if money arrives into the fund during the period, which it does, then the AUM at the end of the month is going to be affected by intra-month returns. And so this definition of flows, of course, is contaminated by intra-period returns. So what we do is we basically try to strip that away, right? So we regress flow on the contemporaneous returns. We also look at the returns from the previous period because we know that fund flows are predictable by past performance, relative performance to be more precise. And that piece, of course, is not what we want. That's kind of a predictable component that could also create a factor structure. So we strip that away. And so what's left is some kind of component theta that is not driven by the interperiod returns or the past returns. So that's the piece of the flows that is common to a bunch of funds. And then there is a fund-specific noise, epsilon. All right, so then we take these components, right? We could take theta and epsilon, and we say that that's going to be our flow shock. So after we strip away the impact of returns, that's what's left, the flow shock. And then we construct the shock at the level of different groups of funds, and we look for some common component there. And so, for example, what you can do is you can group funds by, say, their size. And what you see is that these are, of course, non-overlapping groups. You see that there's a lot of co-movement in fund flows, the way we define it. So small funds, large funds, they experience common movements, and you could extract a common component there. You could group funds by, say, age or in other ways, and you see that there is a common movement. So it matters if the fund is small or large in terms of how much they expose to this common component. But there is a common component and flows there. So what we do then is we just extract a principal component from this cross-section of mutual funds. You could extract it from the cross-section of funds of size or age, and what comes out is a pretty strong first principal component, and they're highly related to each other. You could use one sort or the other. You're extracting largely the same principal component. So this first leading common component of flows is what we focus on, and that is our systematic flow, or common flow. Right, this is the plot of the principal component. You could see that it's kind of robust across different definitions. You could use age, you could use size. You could also use different ways of defining the data universe. You could use CRISP or intersection of CRISP and Morningstar data for the definition of the universe of funds, and you end up with very similar results. Now, when you look at this graph, just visually, what do you take out of it? Basically, the result of movement in fund flows, and it's not just a proxy for the business cycle, right? So it moves around between recessions quite a bit, and so it's potentially interesting that it's going to give you some kind of action outside of the traditional business cycle frequency. All right. Now, let me quickly go through some of the main results. So basically, one thing that we find is that common component of fund flows is negatively related to different measures of economic uncertainty. This is just to confirm that what we assume in the model, that we have this state variable, economic uncertainty. It's not a crazy assumption. It is actually related to flows. But of course, it's also not a complete description. This is just one macro variable. There will be others. We are just focusing on one to keep the model as simple as possible. So this shows up in some market proxies for uncertainty and also in consumption-based measures. And the cross-sectional dispersion of consumption is related to flows. Right, that's just to say that flows are not a sideshow. They are connected to some macro shocks. It's just that it's not the same as the business cycle. It's a different kind of shocks, which makes it actually more interesting. So now flows are priced. So if you estimate, this is a non-parametric estimation. So we estimate betas of stocks on the flows using 3 years of data, monthly data. It's standard, right? Then you sort companies on their estimated beta, form 5 portfolios, and then we check if returns in these portfolios are different from each other, if they're captured by CAPM. The answer is they are different from each other. High beta stocks earn higher returns than low beta stocks. It's a 7% difference in our sample annual, and it's not explained by the CAPM. It's basically mostly alpha, right? So you end up with a significant large alpha, CAPM alpha, which is qualitatively, that's what the model predicts, right? That there are 2 factors here, market and flows in the model. So market beta wouldn't be a sufficient statistic. That exposure to the flows is priced, and when we sort on the flow exposure, we get a spread on returns. Now we can do Farmer Macbeth to throw in other stuff there. Now, what is the point of that? Basically, this is a kind of theory agnostic. It's just a data description, right? We want to say, what are we finding relative to what we already know in terms of empirical facts? this exposure to flows, how does that relate to different firm characteristics? Now, our theory doesn't quite say that these characteristics have to show up, but it's interesting to explore because it may tell us what are the limitations of the model or just how it fits into the grand scheme of things. In short, what you find is this, that some firm characteristics, they are still important and they show up, they're outside of the model. It's basically some proxies for liquidity show up. In this table, what you see is that Amichut illiquidity measure is priced. It's not subsumed by the flow betas. At the same time, flow betas are not affected very much by any of these. So it looks like flow betas provide additional information about returns that's not just simply restating book-to-market effect or size effect. At the same time, this kind of exposure to liquidity is something to watch out for because it's outside of the model, but it could confound our interpretation potentially. Although in this table, it looks like it really isn't the story. It's another story that's playing out there, that liquidity predicts returns. Nonetheless, so...
Leonid, you've got about another 4 minutes or so.
Yeah, I understand. All right, I need to really speed up. So basically, we estimate how betas load on firm characteristics, and we do see that they are related to some characteristics. So it's not a sideshow. Firms with the high book to market, the value firms, illiquid firms, small firms, they tend to have higher betas. And that's an interesting connection with the more traditional quant factors, that it provides another channel for why those characteristics would be priced. All right, so what is behind the flow beta? So this illiquidity is a concern because one could put together a story that is kind of different from what our model says. One could say that maybe what's going on is that some stocks are illiquid. When flows go in and out, their prices are affected more, so they're going to have higher betas. And then as compensation for illiquidity, they have higher returns. So it's really not about beta as a risk measure. It's the risk versus characteristics. It's betas are correlated with illiquidity, and it's illiquidity that's priced. So that's a pretty plausible alternative story. And so what we do is we explore it. Right? We look at several different measures of illiquidity. I'm going to quickly flip through these. So we look at the measure of price impact from Koijan and Yogo, different kinds of price impact. They, of course, not surprisingly, are related to the flow betas, which is what you would expect. And we also look at the flow-induced trading pressure that don't look constructed. That one turns out not to be related to flow beta, so that's a different kind of phenomenon. And then what we do is we just do double sorts on these different liquidity measures. Right? Basically, we look at the flow-induced trading pressure. We look at the price pressure from Koijan and Yogo. We look at the Amichut liquidity measure and historical liquidity betas. That's Pastor Stamba. And every time we do a double sort, we sort on illiquidity, and then after that we sort on the flow betas. The bottom line is that flow betas create a spread on returns. So it's not all liquidity. Of course, the illiquidity matters, but flow betas seem to be robustly priced after you control for illiquidity. And then we find that there are portfolio tilts. So funds tilt away from high flow beta stocks. And that is observed in different ways, right? It's a cross-sectional pattern. You could do relative to the market. You could do relative to the fund's benchmark. There is a tilt, which is highlighted, for example, in this table. And you could do it at the level of funds altogether, if you aggregate them, or at the level of the individual fund. So the tilt is really robust. So now let me quickly tell you about the natural disasters. So we have cross-sectional results, right? That there is a tilt. But of course, it's not quite satisfactory. It would be really good if we could have some source of variation in the incentive to hedge. And then we saw that funds change the amount of hedging. And what we do is we look at the natural disasters that affect different firms kind of randomly. And then you look at which funds affected more or less, depending on what fraction of their portfolio has been exposed to the natural disaster. And the reason why this seems like a promising experiment is that we find that when the fund is hit a lot by natural disasters, their flow risk going forward, specifically outflow risk, rises. They're more exposed to outflows going forward. So their incentive to hedge, if they care about this kind of stuff, should be stronger. And What we do then is we look at the fund, we look at the stocks that were not directly affected by the disasters, right? They just happen to cohabitate. They're in the same portfolio as the stocks that were affected, but they were not directly affected. And then within that group of stocks, we look at the evidence of the funds changing their tilt. And we find that following being hit by disasters, funds tilt away from the high beta stocks among the unaffected stocks. And this hedge, it costs them something. So basically, it's somewhere between 60 and 100 basis points in annualized returns. That's what they are losing, because if they didn't tilt, we can just go back and say, look, let's just do counterfactual. Suppose that they take whatever portfolio they had before the disaster hit, let's just not, after the disaster hit, but before they rebalance, just don't rebalance. Don't change the tilt. What would happen? They would have done better. So they do worse than they could have. There is a perfectly feasible strategy not to change the tilt. They do worse. It costs them something. So that kind of further supports the notion that it's not just the chasing returns and we think they're hedging. They're going against their own interest in terms of average returns, and they're changing the tilt away from the flow risk. So to conclude, fund flow shocks seem to be an important driver. They show up in the cross-section of returns. They are priced. Exposure that is priced in the cross-section of returns. And we have direct evidence that funds seem to care about that. They hedge in a costly way to tilt away from the flow risk. And ultimately, from the point of view of theory, that is a central link between these kind of myopic, naive households and institutions who are more sophisticated, still myopic, but selfish and care about AUM.
Okay, great.
Stop here. Thank you.
Thank you very much. Thank you, Ned. So the discussant is Donglu. Dong, you got 15 minutes.
All right, thanks. Thanks for the opportunity to discuss this very interesting paper. So a very quick summary. So what the paper tries to link asset prices to mutual fund managers' incentives. Now I think this is a very sort of plausible and relevant exercise. For two reasons. Where number one, there is clear conflict of interest between fund managers and fund investors. Right, investors care about fund returns, whereas fund managers care about fund size, because that's how they derive their fees. So fund managers care about both fund returns and fund flows. Number two, mutual funds are getting bigger, right? The mutual fund industry collectively own about 30% of the equity market. So what they do, their portfolio choice is going to have a pretty big impact on asset prices. And what's more, right, a very similar story, managing incentives can be told about other professional money managers, right? Pension funds, insurance companies, many of them charge a percentage fee of the assets under management. Okay, so I think it's very plausible and relevant. Now the paper has two parts, a theoretical part and an empirical part. So to start, the paper provides a theoretical framework for thinking about this link between manager incentives and asset returns, which I'll talk about a couple of things that I think the authors can do. And also provides very strong empirical evidence for two things. Well, number one, the relation between the flow beta and expected returns, and number two, the relation between the flow beta and portfolio tilts. Right? So overall, I think it's a super interesting paper and relevant paper. Okay, so it's a very intuitive model. Let me just very quickly go through the model, and then I'll mention a few things I think could be interesting. It's an infinite horizon OLIG model with risky assets and multiple fundamental shocks denoted by U. And can you guys see my mouse? So first, there's a cash flow process, right? So this H here controls the amount of uncertainty, or think of that as a scaling variable, and the shocks are denoted by U. And this is the process for H. and you can write sort of the log return in the following form. And there are three sets of players in this economy: the direct investors, the fund clients, and fund managers who are homogeneous. So effectively, there's one aggregate mutual fund in this economy. So the technology of the mutual fund is a bit reduced form, right? So we assume, or the authors assume, that the fund managers have this technology to generate a kernel alpha of alpha upper bar. And there's declining or there's decreasing economy of scale. So so there's a cost associated with that, which is a convex function, and there's a fee associated with that, which is f. So the direct investors, they essentially lose out to the mutual fund, right? So the Q is the total quantity of the delegated assets. So they lose out alpha upper bar times QT, and then their portfolio choice is essentially the mean variance efficient portfolio. Now the fund clients receive some benefits, private benefits from delegation. Just make sure those guys are happy with delegation, and then they try to maximize their expected utility. What's interesting is the fund managers, right? So the fund managers derive utility from consumption out of their fees, the fees that they generate from from the assets they manage. The CMT plus one, the consumption next period depends on future fund size, so fund flows, which also which in turn depends on the state variable H and the set of U shocks. Okay, so consequently, fund managers have an incentive to hedge against the flow risk. So effectively in the APT framework, the U shocks drive both the multiple U shocks drive both returns and flows. And I think it's important to have multiple factors, right? Because it's the same set of U shocks. If it's a one-factor model, then the returns and flows are going to be perfectly correlated. If you have multiple factors, then the loadings are going to be different, right? So the RM, the market portfolio, and the flow factor are going to load differently on the U shocks, and we could essentially derive two betas, the cap M beta and the flow beta. And what the paper shows is, subsequently, empirically, that the flow beta also matters in the cross-section of average returns. Okay, just a couple of very quick thoughts regarding the model. At this point, the alpha technology is assumed in the reduced form. It'll be really cool to endogenize this technology, right? So let's say we assume mispricing in the cross-section due to demand shocks, then mutual fund portfolio choice is going to be determined by both their hedging motives and their incentives to correct mispricing. And I think the benefit of doing that is twofold, right? Number one, we could say something about market efficiency, right? How market efficiency varies over time as a function of mutual fund flows and the portfolio choice of the managers. And number two, I think it's very interesting to study the interaction between flow betas and mispricing, right? Because when mutual funds trade, when mutual funds try to correct mispricing, when they trade, they're gonna move prices, and the flows also, the flows coming from the clients also load on fundamental shocks. It'll generate some interesting interaction between the flow betas and the mispricing in the economy, which I think will be very interesting to study. Now, the second thing I want to say is that, well, a key assumption in the model is that managers are essentially homogeneous. Now, in practice, of course, there's huge heterogeneity across mutual funds, right? We have sector funds that track auto industry, that track energy sector. We have value versus growth funds, small cap, large cap funds, balance funds, and many intersections of these characteristics are these styles. Now, one potential way of extending the model is to apply the framework of continuities and Duffy 1996, right, to allow for heterogeneity across mutual funds. In that case, the expected returns will depend not only on the aggregate flows, right? In the continuity and Duffy case, the expected returns depend not only on the aggregate or the representative consumption growth, but also the variation, the cross-sectional variation in consumption growth. So in this case, the expected return will depend not only on the aggregate flows, but also on the cross-sectional variation in the flows. Now, doing so will make the model potentially fit the data better, which I'll come back to in a second. Okay, I think the empirical analysis are super well executed. So I'm just going to pick bones with some of the empirical analysis. But the first thing is the construction of the common flows. So Leonid explained very clearly how the common flow shock or the flow factor is constructed. Right, we start off with this capital F, which is of the percentage flow that the literature has been using, and then we get rid of the part of the flow that's related to contemporaneous fund returns and also lagged fund returns. Essentially, we get rid of the part that's related to fund returns, and we keep theta T and epsilon IT. So that's what we call individual fund flows. And the common flow shock is the first principal component of fund flows across mutual funds. Okay, so it's a very intuitive definition of common flow shock. Couple of thoughts. Well, number one, flows are highly persistent, right? We know lag flows explain more than 20% of the variation in future flows. So if we want to think about flow shocks, right, we should probably control for lag flows in constructing this flow variable. I'm not saying this is going to change the results. I just think that this is probably a slightly more kosher way of constructing flow shocks. And in terms of the principal component, I think it's a very intuitive approach. Now, the concern I have is that just imagine two mutual funds, right? One with $10 billion and the other one with $1 billion. We're going to treat them essentially. We're going to give them equal weight, right, in computing the principal component. In the extreme case, let's say we have two $10 billion mutual funds, and then the second one is split into 10. Then we have 11 mutual funds. Essentially, the second mutual fund, the second $10 billion fund is going to dominate the calculation of the principal component. Now, sort of the point I'm making here is that, well, there are just many more small mutual funds than large mutual funds. Right? I understand the authors did a bunch of things, try to control for size, right? They sort mutual funds into different size groups. Well, the potential issue here is that the size distribution of mutual funds is extremely skewed, right? You have a small number of funds that are mega funds. So one thing I would like to see, or I would recommend the author to do, is to try AUM weighted flow as a measure of the flow shock, right? This is actually what the model tells us, right? Remember, the model has only one aggregate fund. It is the mutual fund industry, and it's the AUM weighted aggregate fund. Okay. Now here's some results sort of related to this point. So here what I'm showing you is the relation between the flow beta and stock characteristics. What kind of stocks load more on common flow shocks? Well, it turns out it's the smaller stocks and stocks that are less liquid, as Leonid pointed out. So one possibility is that we are essentially giving a lot of weight to the small mutual funds, which tend to hold, right, smaller stocks and less liquid stocks, right? Because remember, large mutual funds just by construction or by definition are unable to hold small cap firms and illiquid firms, right? Because they're going to move the prices too much. Okay, and to the extent that flows can move prices, right? So the stocks that are heavily held by smaller mutual funds are going to have larger betas, and they tend to be smaller stocks and less liquid stocks. Okay. Now the second thing I want to say, which is also related, is the calculation, or is the regression of the underweighting, the relation between portfolio tilts and flow beta. So here in this table, the dependent variable is the portfolio tilt. So it's a WMF minus WM. So WMF is calculated at the fund industry level. Okay, so we're looking at this aggregate mutual fund, and we look at stock I's weight in this aggregate portfolio, and then we compare that to the market portfolio, right? So MF is actually AUM weighted, right? So we're giving essentially a lot of weights to those mega funds, and on the right hand side, the betas are the flow shock, right, is essentially equal weighted because we're using the principal component. So there's a bit of a mismatch between the left hand side and right hand side, and one possible explanation, alternative explanation for this result is that we are on the right hand side, we're giving a lot of weight to the small funds, and small funds tend to hold less liquid stocks and smaller firms, and on the left hand side, this WMF is going to be essentially driven or determined by a small number of mega funds, and those guys are holding large cap firms and also very liquid firms, right? So there's going to be a slight negative correlation between the portfolio tilts and okay, now what I'm saying so far, all I'm saying so far is, really boils down to this quantitative exercise. Now, what I think it'll be super convincing if the authors can provide a quantitative exercise to match the quantities, right? So remember, the core idea of the paper is that fund managers consume out of their fees, which are a function of the fund AUM, and therefore fund managers have an incentive to hedge, right, against the flow risk and tilt their portfolios away from the stocks with high flow betas. And subsequently, managers' portfolio choice has implications for asset returns, right? So it's really three things, right, in this in this framework. Managers' compensation scheme, which determine their incentives to hedge, and then their portfolio choice, the portfolio tilts, and number three, the risk premium associated with the common flow risk. Now, can we match these three quantities? In the framework that was introduced in the paper, right? But differently, does the magnitude of the risk premium on this flow risk line up with a plausible calibration of the asset manager's compensation scheme and risk aversion, right? Can we actually explain the risk premium using the model provided in the paper with reasonable parameters? Okay, now if the authors can do that, can show this, can provide this quantitative exercise and generate a reasonable risk premium, I think that'll be very convincing, and that'll essentially alleviate a lot of the concerns I had in the previous two slides. Okay, and some minor comments on the empirical analysis. Now, I really
you've got like two minutes. 2 minutes.
Yes, I have two slides left.
Okay.
Perfect. So, the first thing is I really want to understand what is the driver behind individual stocks, flow betas, right? Why some stocks have high betas and some stocks have low betas? Are they all driven by cash flows? We can potentially test this, right? Just look at how much the cash flows of stocks load on different will load on the common flow shocks, and how persistent are the flow betas over now overlapping horizons, of course. As I mentioned, this flow-induced trading idea or mechanism may play a role in driving the flow betas, and how much of the flow betas are driven by flow-induced trading. Okay, and then in the paper, in most of the return tests, the authors control for the CAPM model, and I think it's reasonable to also control for size, value, and momentum and other things, right? Because mutual funds indeed have substantial exposures to these styles and factors. Here's really nitpicky. So so this is table 5. It's a Farmer-Macbeth regression of future stock returns on lagged betas and stock characteristics. I just want to point out one thing. Now so the sample period is from 92 to 2018. Actually, momentum doesn't work at all, right? Actually, if you look at the coefficient of momentum, it's slightly negative, and then there's a very strong negative coefficient on short-term stock returns. Now, what this seems to suggest to me is that microcap stocks are playing a pretty important role here, because we know momentum doesn't do very well with microcap stocks. And remember, from 92 to 2018, over this 30-year period, momentum works fairly okay. So it's not, and seeing a negative coefficient in front of momentum is a little bit strange. So I would certainly try to exclude stocks in the bottom size decile of the NYC sample, just make sure the results are robust to excluding my. Okay, let me conclude here. I think it's a super cool paper. It's very interesting and relevant, and the results are certainly robust. 3 main comments were: number one, in terms of the construction of the common flow factor, I would think AUM-weighted flow shocks are a reasonable alternative to this principal component approach, because it's more closely tied to theory and less affected by small funds, and more aligned with the exercise on portfolio tilts. Right? Remember, in the portfolio tilt analysis, the left-hand side variable is actually AUM-weighted, and the right-hand side is more driven by the smaller funds. And above all, I think a quantitative exercise to match those different quantities would be very interesting. Right? Does the risk premium on the flow risk actually line up with a plausible calibration of manager's compensation scheme and risk aversion? I just want to understand sort of the relation between these different quantities. And the author can also consider the heterogeneity across mutual funds, right? Then the cross-section variation in fund flows could also play a role in driving expected stock returns. That'll be interesting to know. Thanks.
Wonderful. Okay, thank you very much, Dom. So, Lena, do you want to just react to Dom's comments? And then, for everyone else, if there are any questions, just raise your hand, click the hand-raising button, or say so in the chat, and I'll call on you. But Leonard, over to you.
Dong, thank you very much for the comments. I don't want to spend a lot of time. Basically, many of these things we sympathize with, but we actually are working on a bunch of stuff that's closely kind of correlated. For example, cash flow risk, I didn't present these results, not in the paper yet, but these flow betas, they do predict cash flow risk. So it's not all about kind of valuation multiples. You do see that firms that have high beta on flows in terms of returns, also their cash flows have high exposure to the common component of flows, which is very encouraging, because in the model that's kind of 100%, right? We don't allow for liquidity effects. So in the data that's going on, also some of these results, we do them, for example, for the mutual funds that follow S&P 500 as their benchmark, and we look at only S&P 500 stocks of the universe. We see tilts there. So that clearly is not about microcaps, but a bunch of these sort of additional empirical tests, it's very reasonable, right? One can enhance kind of robustness of the results by a few things. In particular, definition of flows, there is no unique definition, and we have tried a few, right? So it's very reasonable to control for the lagged flows. We do that down the road. We do that kind of downstream in many of our regressions. but one can also do that at the level of the definition. So I'm going to stop here, but thank you for the comments. It makes a lot of sense to us.
Okay, great, thank you. So I think we've got three questions. First of all, Andreas Schrimpf, and then Igor Makarov, then Dimitri Vayanos. So Andreas, do you want to unmute yourself?
Yes, thanks. So I'd be interested in, also the limits to this tilting activity that you document, and in particular the role of the tracking error, because I guess maybe the retail investors won't pay so much attention to the tracking error, but for sure, when you're looking at pension funds or so, they would be investing in some of the mutual funds. They would factor in the tracking error as well. So I guess this would pose a natural limit to the ability of the fund managers to tilt, because in turn, that may be a drag on AUM also down the road, especially if you have a high institutional investor base. So I was wondering maybe if you could therefore split the sample or analyze to what extent your effects are perhaps stronger for the retail-dominated investor-based funds.
It's a good idea, but they have essentially other incentives pushing the other way. So we're not looking at tracking error specifically, but it makes sense that funds more concerned about tracking error, they will be less inclined to deviate from the benchmark. So their hedging tilt should be weaker. Now, to what extent we'll be able to find that? Obviously, the more you slice the data like that, the less statistical power you're going to have. But it's a cross-sectional prediction, so it's kind of interesting. Explore that. Yep.
Okay, Igor, do you want to unmute yourself?
Hi, yeah. It seems in this theory, what is important, right, is the relation of the mutual fund flows with anything that would predict these floors. And I think we have some evidence that it's not just maybe past returns, right? And it also would be maybe how a particular mutual fund is doing relative to other mutual funds. And in that sense, it's also like all the possible variables that predict expected returns, because if I want to maximize my flows, I want to maximize kind of my, well, past return, but also like expected return. So it seems when you extract this systematic component, right, you might in principle, at least in theory, not just past returns, but anything that predicts returns, and also even the cross-section of mutual fund returns, right? You can want to see like momentum in these guys, I don't know, which probably investors react. So, and that might affect, again, ultimately how you link your systematic component to whatever factors will be left.
It's in theory, it makes sense to try to remove anything that predicts fund flows. Of course, in reality, how can we do that? That's sort of the limitation. So we try to be fairly minimalistic in terms of what we remove when we construct the flow measure. So I don't disagree, just that there is a trade-off, right? The more stuff you try to control for, the less conventional the resulting measure is going to look. So also, the other thing that I want to be clear about is that it's really about the contemporaneous relation between flow and returns, right? It's not about the expected component of flows. It's the unexpected piece, right, that we are focused on. To what extent we kind of minimize the influence of the expected component of the flows, it's kind of hard to say. We try to do that using control for returns, but there may be more stuff that one can remove that predicts flows. Yeah.
Okay, I think we've got time for one more question. So Dimitri.
Yeah, so I thought it was super interesting as well. So first, one question is about kind of just to build a bit on Dong's point on heterogeneity across funds. So in principle, you could construct a beta of a flow on flow. In other words, how much the flows of a fund when your measure of aggregate flows is large. How large are the flows from a particular fund? Which funds, in other words, are most sensitive to flows, and see whether the tilt is bigger for these funds. Perhaps you have already looked at this. The other thing that I want to say kind of is just more of an observation, which is that you make this kind of equivalence between kind of what individuals want to hedge and what managers want to hedge. This, I think, can depend a bit on the details of the model, because it can be the case that, for example, things that induce individuals to flow out of funds can be good things for them, can be a good state for them that they may want to flow out of equity funds. But for managers, this is always a bad thing because they lose a flow. So it's not. I don't think it's a universal observation, although it may be true in your setting. Yeah, that's it.
So I completely agree with that. In a sense, it's not a universal thing. In fact, that makes it kind of interesting, because if you think about the world through a neoclassical model, you're going to end up with different qualitative conclusions about what is a good state or a bad state versus this environment sometimes. So sometimes they're the same. Maybe a lot of the time they're the same. But there could be discrepancies. There could be shocks that households should be hedging in an ideal world if they're forward-looking. But if they don't affect the flows right away, then fund managers are not going to hedge them, right? So that's not going to, the invisible hand is not going to work. You're worried about the invisible hand moving the other way, essentially, that funds basically think something is bad and the individual thinks it's good and they're selling stocks. So, because maybe they want to buy houses or something like that. So that's fine. It's quite possible. That essentially, I would say that once you're at that level, then that means that you kind of probably bought into the main premise, and now you're thinking, and where does it go the other way? I'm fine with that. We're trying to do the proof of concept of the basic idea that this phenomenon exists and it matters, but it's not going to be as kind of linear, simple thing, obviously. So I agree with that. And as far as the first exercise you mentioned, we have a very long online appendix, and there's a high probability that this is somewhere there because we did look at this kind of stuff before. But I would have to look up the numbers. But yes, that is a reasonable hypothesis. Absolutely. I should also say that our natural experiments are kind of in that spirit. It's just that what you're describing is more of a cross-sectional thing. And as soon as we do that, one can say, but wait a second, this is a cross-sectional result. And maybe there are other things different about these funds that correlate with their flow exposure to exit flow. So that's why we're trying to do something where we look at the same fund where the exposure to flows how changes, and then we see how they change the tilt, but it's in the same spirit.
Wonderful. Well, thank you so much, Leonid. Thanks to both presenters and both discussants, and to all of you for participating. So we're just over time now, but let's take a break for, we come back at 45 minutes past the hour, so let's have a quick lunch break or breakfast break, depending on your location, and I'll see you in a while.
For the final session of this really engrossing conference, the final session is more on the international angle, although I suppose I should say the global angle. You know, there is a difference between global finance and international finance, as you'll see. And I think we have three very, very important papers that have really pushed the boundaries on why international finance and global finance are different, and why we need to focus on the global nature of the financial markets. Without further ado, let me hand over to Ralph. So Ralph, 25 minutes for you, and then 15 minutes for Andrea Vedolin, who kindly accepted to discuss this paper. Ralph.
Okay. Thank you so much for inviting us, including us. So this is joint work with Modo Yogo, and so the main goal of this paper is to estimate a global asset demand system, to understand fluctuations in exchange rates, equity markets, and global fixed income markets. And just make sure we're on the same page. Like what we're doing here and what we've been doing in like a series of papers is to use sort of a demand system to understand asset prices. And what I mean by that is that if you think about sort of the basics of asset pricing, then once you specify like preferences, beliefs, technology, and endowments, we get sort of a demand curve for assets. We impose market clearing and outcome asset prices. Now, typically, we don't sort of like use portfolio holdings in testing those theories. And so what we want to do is have an equilibrium model where we're matching both prices and macro fundamentals, but also portfolio holdings. Okay, and so that's going to be sort of the new data, the new target moments that we want to add, and you'll see sort of like what we think we can learn from that. And so in this case, we're going to apply it to global markets. There's going to be two components to the model. The first part are demand curves for global investors. So those global investors at the country level, they're going to allocate their capital to short-term debt markets, long-term debt markets, and equity markets across many different countries. And so we need to think about substitution across asset classes and within an asset class across different countries. Now, the demand of each country is going to depend on expected returns and macro variables. The second part of the model relate to like policy. So we're going to have think about sort of like conventional monetary policy, setting short rates and associated debt quantities, but also sort of like long-term debt quantities associated with fiscal and unconventional monetary policy. And another aspect that's going to be important in the model and in the results is the role of foreign currency reserves. So those are like the holdings of central banks of foreign assets. So what we do in the paper is we're going to use data from 2002 until 2017. The model is going to sort of like give interpretations to fluctuations in exchange rates, asset prices, and macro variables across 36 countries, both developed and developing economies. In terms of the portfolio holdings that we're going to use, we're going to use data from the IMF, the Coordinated Portfolio Investment Survey, the CPIS. Now, what are the applications? So the first part of the paper is really just developing that framework, bringing it to the data, and then once we have that sort of like model estimated, what can you do with it? So we're going to give interpretations in terms of like why exchange rates and other asset prices fluctuate. And think of that as kind of like, I don't know, Campbell-Shiller style sort of interpretation of like trying to understand sort of like at a more granular level why prices move. Then we're going to zoom in on the European sovereign debt crisis and two aspects in particular of that. So we're going to sort of like see how the model interprets sort of like the widening of like spreads between Greek debt and German debt, and then how that spills over to other peripheral countries like Italy, Spain, and Portugal. The second application is that sort of like following the European sovereign debt crisis, there was sort of this widening gap between long-term interest rates in Germany and the US. And it was like, I don't know, something like close to 2.5 percentage points difference between 10-year interest rates. And so again, we're going to sort of like ask the model, like how that's being interpreted. And then as the last application, we're going to look at like quote unquote convenience yields on US assets. So there's obviously like a very large literature on convenience yields on safe assets. We're going to show that there's not only like an outsized demand for US short-term bonds and long-term bonds, but there's actually also a large demand, sort of like exceptional demand for US equity. And so we're going to sort of quantify that, and we're going to sort of like measure the implications for asset prices if that demand would not be there. Okay, so let me get into some of the details. So in terms of data structure, as I mentioned, we're going to run from 2002 to 2017. We're going to have data across like 3 different asset classes: short-term bonds, long-term bonds, and equity. In terms of like investors, we're going to have like 88 different countries for which we have bilateral positions across other countries. And then we have like foreign currency reserves. Unfortunately, due to data confidentiality, we do not have disaggregated data country by country, sort of at the bilateral level, what those positions are. And so we're going to think of like one foreign currency reserve like investor that manages like all of those portfolios. Of course, if you would have better data, you would be able to improve on that part of the model. In terms of like assets that those investors can allocate their capital to, there's going to be 36 issuer countries. For those countries, we have complete data on asset prices and characteristics or macro fundamentals. Those are all of the 22 countries that are part of the MSCI World Index, but then there's also 14 out of the 21 countries of the MSCI Emerging Market Index. For the allocations to all the other countries for which we have incomplete data on either prices or characteristics, we're going to aggregate those within an asset class to an outside asset. And you'll see the role of that later on. Now, then the last thing I need to tell you is about sort of how we define supply or how we think about supply. So for equity markets, it is a total stock market capitalization held both domestically and by foreign investors. For debt markets, if you think about the level of a country, then debt being sort of like issued and held within the same country from national accounting purposes is going to cancel out. And so this total supply is debt is whatever is being held externally. Okay. So let me just sort of first start with like a series of basic facts before showing you the estimation. So there's these 3 asset classes, as I mentioned: short-term bonds, the first column, long-term bonds, second column, and then equity. There's 3 observations here. So you see the largest investors here by asset class. But if you first go across the columns, you see that short-term bond markets are smaller than long-term bond markets, which are again an order of magnitude smaller than equity markets. The second observation is that foreign currency reserves are actually very large. So in short-term bond markets and in long-term bond markets, they are the largest investor. Okay. The third observation is that financial centers play an important role. You see, like Ireland, Luxembourg, Cayman Islands show up in these different asset classes. Okay, and so you'll see that later on in the estimation that's going to play a role as well. Okay. So then another feature that's important once you start looking at holdings data, and this is something that we've seen in several markets in our papers, is that demand appears to be inelastic. So demand curves, like in our standard theories, are essentially flat. That means that like flows into different markets wouldn't move prices very much like at all. Now, what we're going to sort of like do here is first provide some very suggestive evidence, just scatter plots. We're not going to think about causality very much at all here, of like relative quantities versus like relative prices. And then later on, we're going to be more careful with identification to try to estimate slopes of demand curves. So we're going to do this for long-term bond markets and for equity markets. So what we're going to plot on the horizontal axis is the relative quantity. So for instance, for equity markets, that would mean that we take the logbook equity of, let's say, Japan, all Japanese firms, relative to the logbook equity of all US firms. Then we're going to compare that to relative prices in Japan and relative prices in the US. In this case, that will be market to book ratios. In case of equities, it will be bond prices per unit of face value in case of bond markets. Okay, and the main point here is to show that there's like sort of like a very, very sort of salient negative correlation between relative quantities and relative prices. So here you see that for 4 geographies. So top left is Euro, Japan, Switzerland, and the UK. And so this one is for long-term bonds. Each of the boxes corresponds to a year, so the number in the box is the year. So let me sort of like walk you through the Euro area example so you have sort of an idea of how this works. So over here, if we go to the left, that means that there's like the quantity of debt in the Euro area held by foreign investors is going down. So you see over here, if you go from like 15, 16, 17, you see that the amount of debt being held by foreign investors goes down, which is something that Modo and I showed in some of our earlier work, that as the ECB starts buying bonds, like a lot of those are being sold by non-Euro area investors. And as a result, sort of quantity goes down and prices go up relative in the Euro area relative to the US. You can do the same exercise for equity markets. And again, you see sort of this like negative correlation between relative quantities and relative prices. Okay, and so this kind of like foreshadows some of the results we will find later on, namely that demand is inelastic and demand curves are downward sloping. Okay, so let me get into the model. So I'm going to first tell you about the market clearing equations that we're going to use. Think about sort of how exchange rates are being determined, and then I'll tell you about how we specify and estimate demand. So the market clearing equation is specified for a given asset class, let's say equities, and then for a given country N. So the left-hand side here is total supply. The price over here is either the market to book ratio in case of equity, or in case of bonds is the price per unit of face value. So this one doesn't have a currency denomination. Then Q over here is the quantity of either debt or the total book equity denominated in local currency. And then E over here, that's the exchange rate denominated in dollar per unit of foreign currency. So that means that the product of the three is the dollar supply of either short-term bonds, long-term bonds, or equities. Then on the right-hand side, we have total demand. So A over here, that's the total like sort of like assets of a particular country. W, I, T, and L is the fraction of those assets that are being allocated to a particular country in a particular asset class. Okay, so what we're going to do is we're going to model the demand over here and then try to sort of use this to think about fluctuations in financial markets. Okay, so a couple of things about sort of like, I don't know, counting equations and how prices are being determined. What is endogenous here? So we're gonna have within the euro area, we're gonna assume that short-term bonds across all countries in the euro area are perfect substitutes. And so that means that we do not have like 36 market clearing equations, but there's only 26 of them plus the euro area. Then there's like 36 market clearing equations for long-term bond markets, 36 for equity markets. Now, what we're going to assume to sort of like pin down exchange rates is we're going to assume that the short rate is being set by central banks. So that means that for the first like set of market clearing equations, there's no price that adjusts to sort of make sure that those markets clear. So you need something else that gives. And so what we're going to do is we're going to assume that the exchange rate over here is going to adjust to make sure that markets clear. And so that means that we're going to solve for like exchange rates, long-term yields, and equity prices to make sure that all of the market clearing conditions hold. Okay, so ultimately what you end up with is a model that connects portfolio holdings, prices, and these macro variables. Now, what we want now is a sort of like empirically plausible model that captures like substitution patterns across and within asset classes. So in order to do that, we want to start from theory, and this is based on some of the earlier work that we have done, where we showed that under sort of like very standard assumptions that we typically make in empirical asset pricing and macro finance, there's a very sort of like natural structure that comes out. So let's start from like mean variance portfolio choice. So we're going to allow for differences in beliefs about expected excess returns μi, and investors can have different views on riskiness and correlations as captured by the covariance matrix sigma I. Now, normally this looks like a very, if you're going to do this with lots of assets, this looks like a very complicated problem because all the expected returns of all the assets matter for my demand or my allocation to, let's say, UK equities versus like German bonds. So we're going to make two assumptions. First is that returns have a factor structure, which is something that we typically assume. And the second thing that we do is we assume that expected returns and the loadings on the factors only depend on the characteristic of a given country. So what that means, like if you think about, for instance, like the cross-section of stocks, what that means is that the loading of Apple, let's say the market, depends only on Apple's characteristics. Or in a global context, the exposure of like UK equities on the global factor depends only on the characteristics of the UK. Okay, this of course implicitly is what we do in lots of like empirical exercises where we sort countries on like variables associated with that one country. Okay, that implicitly assumes that the riskiness and expected returns are associated with those characteristics. So under those two assumptions, it turns out that the mean variance demand curve simplifies like a lot. So it turns out that your relative weight in a particular country, relative to some constant, depends only on the price of that country and the characteristics that capture risk and expected growth. And the reason, like sort of like where do all the other prices and characteristics show up, they're all embedded in this like one scalar over here. Okay, and so we're going to sort of like use that structure in our empirical specification. So what we're going to do is that demand that we have over here, that is an allocation to a given country within an asset class, we're going to break it down into two pieces. First, we're going to think about the allocation within an asset class. So how much am I going to allocate to like the UK versus Germany, let's say. And secondly, we're going to think about the allocation across asset classes. And so relative to like some of the earlier work we've done, we're going to allow for more flexible substitution patterns, which we think is important if we think about different asset classes. Okay, so we're going to, for the allocation within an asset class, we're going to use a logit specification. So demand over here depends on these deltas. This is just to make sure that these are portfolio weights, so they sum to 1 within an asset class. And then the sensitivity or the deltas depend on expected returns over here. The sensitivity is beta L. Then there's going to be some characteristics, and then there's going to be demand sub epsilon over here. Then the allocation across asset classes looks a little complicated at first, perhaps, but the way to think about this is that the sum of these deltas captures the relative attractiveness of a given asset class. So if all the deltas are high for equities, equity markets are relatively attractive. What this parameter lambda over here captures is that as sort of like equity markets become relatively more attractive, how quickly do I substitute away from like short-term bonds or long-term bonds to, let's say, equity markets? And so two sort of like extreme cases are useful here. If lambda is 1, then the substitution within and across asset classes is the same. Okay, so then everything will be perfectly integrated in sort of the standard way. If lambda is equal to 0, then there's like segmentation across asset class. So even if asset prices move in equity markets, it doesn't do anything for my demand in long-term bond markets. Of course, that's also like a strong alternative case, and so we expect lambda to be somewhere in the middle. Okay, so in terms of like characteristics, we're going to use macro variables. I'll talk about those a little bit later. There's going to be bilateral variables because we know that things like import-export shares and distance matter. In terms of like how to interpret those in the context of the micro foundation, you can think that like countries that are closer to one another, there's like better information. And as a result, I perceive those countries to be as like less risky compared to countries that are further away. And then there's going to be dummy variables. First of all, there's like own country dummy, which is capturing home bias, year fixed effects, and then importantly, US issuances interacted with year. And that's going to sort of like estimate the special demand for US assets. So the way to think about that conceptually is sort of like, suppose you try to estimate demand on all countries excluding the US, and you see like what sort of demand would you predict for US short-term bonds, long-term bonds, and equities, then you find that there's like an outsized demand for like all assets in the US, not just the safe ones. Okay, and so the equity component there is a new one, I think. So in terms of identification, we sort of construct an IV estimator that allows us to estimate demand elasticities. Okay, so let me show you some results. So what you see over here is the estimated demand within a given asset class. So short-term bond markets, long-term bond markets, and equities. And so what you see over here, this is the sensitivity to expected returns. Now it's easier to map this to demand elasticities. So the demand elasticities for short-term bonds is 40. The demand elasticity for long-term bonds is 4, which is actually very consistent with sort of the QE evidence that people have found, like Arvind and Annette's work. And then the demand elasticity for equity is around 2. You see that that's almost a unit elasticity with respect to country size, log GDP, a positive association with how rich a country is, GDP per capita. There's a negative association with inflation, which is particularly strong in fixed income markets. So if inflation is 1 percentage point higher, then the demand for long-term bonds drops by 20%. There's a negative association with risk variables, either measured through equity volatility or ratings of a country. Strong connection with like import-export shares, and then I mentioned distance before, so you allocate way more capital to countries that are close to you compared to countries that are far away. Lastly, for equity markets, there's a home bias, and so there's a coefficient of 7. What does 7 mean? That means that like you're allocating 7 times as much to your own country, given characteristics. So that home bias is very, very strong. Across asset classes, we find that there's sort of like imperfect substitution, but they're certainly not segmented. So these lambdas over here, remember that lambda 1 would mean perfect integration, lambda 0 means like perfect segmentation. We find somewhere, somewhere in the middle, which means that if you're studying sort of global bond markets, it's important to account whatever happens in equity markets and vice versa. So studying those in separation is potentially an important restriction. Okay, so now let's see what we can do with this. So what we're going to do is we're going to do a variance decomposition. So in our model, like what is endogenous are exchange rates, long-term bond prices, and equity prices. Those are determined by macro variables, short rates, conventional monetary policy, short rates and short-term debt quantities, long-term debt quantities. Then we have foreign currency reserves and the demand shocks of all the other investors that cannot be explained by observed characteristics. What we're going to do is we're going to move all of those, like one step at a time, from one year to the next. Once we move one group of variables, we recompute prices, and then we do a variance decomposition. And so that sort of like allows us to understand like what are the main drivers of prices in the model. So here's what you get. So adding up these columns, you add up to 100%. So for exchange rates, let me focus on the first column over here. For exchange rates, 26% of the variation can be explained by macro variables. Another like 10% by sort of monetary policy, so short rates and debt quantities. And then another 20% by foreign currency reserves. So this is sort of an important observation that sort of foreign currency reserves during this period drive a non-trivial fraction of the fluctuations in exchange rates. Now then there's another 45% that is like latent demand. Those are demand shocks in the model, but what is sort of like appealing about the demand system is you can sort of now sort of like trace back like where those demand shocks come from. I'll talk about that on the next slide. For long-term bond markets, you see that a big part of this is driven by policy variables as well, with about 40%. For equities, policy variables are slightly less important, but macro variables explain about 60% of the variation. Now, if we decompose demand shocks for exchange rates, then you see that there's sort of two types of demand shocks that are particularly important. So it's the demand shocks in short-term bond markets, and in particular those that go through offshore financial centers. So those explain like a third of the fluctuations in exchange rates. The other part of the demand shocks that are important are those across asset classes, and in particular those from like investors in North America and Europe. So those explain about 8% of the variation each. Okay, So then as a second application, we're going to look at the European sovereign debt crisis. We're going to focus in particular on this wedge between German and US interest rates and what happened to like contagion in Southern Europe. So if you do the same variance decomposition and you focus on the spread between Germany and the US, then what the model tells us is that a very large fraction of the variation is driven by short rates and debt quantities. And so given that the model sort of like makes a very sort of like stark prediction there, you can actually sort of go directly back to scatter plots and see that in the raw data without any estimation. So what you see here in the left figure is the relative short rate in Germany relative to the US. Vertical axis, you see the long-term interest rate. And so the model sort of like kind of easily identifies this because the moments where like there was accommodation in the US versus the euro area are quite different. And that sort of like allows you to trace out this sort of like fairly clean relationship. Similarly, if you look at debt quantities, you see a similar relationship between relative debt quantities in Germany and the US versus long-term yields. And then the second part is about sort of the spillover in government bond markets. And so, of course, we all know that sort of like during that period, like Greek yields jumped up relative to German yields. And what is interesting is that we're estimating our model on like 36 countries over like a 15-year period. We zoom in on this like one particular period, and the model almost perfectly explains what happens to Greek yields just with macro fundamentals. Okay, so it doesn't require any demand shocks really to interpret that episode. If you then look at like Italy and Portugal, the model doesn't explain like anything in terms of like fluctuations in yields using those macro variables. And so normally we would say like, well, there's contagion spillovers, or I know you give your favorite term. Now what you can do with the demand system, and that's sort of the value added of going back to holdings data, is we can actually sort of ask, well, whose demand shocks caused the contagion? Like whose demand changed so that like yields in Italy and Portugal spiked up even though there was no change in macro fundamentals? Normally, you wouldn't be able to do it because you only see price movements. Now, it turns out that it's actually the demand shocks of Northern European investors that pulled out of peripheral countries, and that's why you saw the spillover from Greek markets to the other countries. Okay, so that's a benefit of looking at holdings data beyond prices and fundamentals. Okay, so the last application that I'll briefly mention is sort of the convenience yield on U.S. assets, and of course, this is like a very active like area where many of you have like contributed to. And sort of like the main point here for us is that one, you can sort of like estimate the convenience yield using the demand system, but you can also extend it to other asset classes. So a lot of the work has been on safety, a lot of interpretations around safety and things like that. We're going to sort of show that there's also a convenience yield for equity markets. So there's like an outsized demand for all assets, short-term bonds, long-term bonds, and equities. What you can then do is you can switch off those dummy variables and ask how would assets reprice if that special demand for U.S. assets would not be there. And so what would happen is that the dollar would depreciate, and the expected exchange rate appreciation per year would be 1.3%. The impact on the long-term bond yield would be 2%. Equity risk premium would be 1.7% higher if that special demand would not be there. Again, what is the value added of doing of going through the efforts of the demand system is we can actually break it down by country, and we can sort of see like which investors are driving that convenience yield. And what is interesting, which is sort of like something that I'm not showing here, but we're sort of adding to the paper, is that it turns out that the same countries that have a special demand for U.S. equities also have a special demand for U.S. long-term bonds. So there seems to be something sort of in common across asset classes in terms of like who has a special demand for those securities. Okay, so we can do this by year. You see that the convenience yield, when it's large, it's moving over time, and it actually reaches its peak in 2011 during the European sovereign debt crisis. And so we think that's quite interesting. So let me summarize because I think I'm out of time. So what we do is we estimate a global asset demand system to understand sort of like movements in exchange rates, long-term yields, and equity prices. Like one of the things that is important is that you see significant substitution patterns, and so studying those asset classes together we think is important. Secondly, we sort of find an important role for policy variables. It varies by asset class, but for exchange rates, there's about 30% of the variation is due to policy variables. In long-term bond markets, it's 40%, and it's a little over 10% for equity markets. Now, in terms of like next steps, you can sort of think about implications for international macro models. So there's like a growing literature that now adds demand shocks uncorrelated to fundamentals to explain exchange rate fluctuations. Now, essentially, we have measures of those demand shocks. So we can study its properties in terms of like volatility, correlation, and persistence. In terms of like next steps, one thing we're working on is to use this framework for monetary policy evaluation. Because one of the things that sort of like the luxury we had before was that QE programs were kind of implemented in a staggered way in the US, Japan, in Euro and so on, Euro area and so on. What happened last year is that sort of like lots of central banks of course moved at the same time. And so understanding the impact of that really calls for like a framework that can handle sort of like demand shocks from lots of central banks at the same time. And the model is able to speak to that. And so we can sort of see how well the model works or where the model needs improvement. The other thing we're doing is to add dynamics and endogenize the macro variables, which we think is important. And then lastly, one of the things you can do with this as well is to use this model for questions related to fiscal capacity. Because essentially, like there's lots of people arguing now that like maybe government debt is very expensive, is mispriced and things like that. We can effectively ask like which investors are not pricing those fiscal variables like properly, and how much more one could issue in developed economies before yields start to rise significantly. And so that's it. Thank you. And we look forward to Andrea's comments.
Great, thanks, Ralph. The discussant is Andrea Bedolin. Do you?
I cannot share.
Simon, can we share the ball with Andrea? Oh, great. Thanks. Go ahead.
Oh, sorry. Okay, thanks a lot for having me discuss that paper. As I told Ralph, I was intimidated to do this discussion, the reason being because probably everyone in the audience has already seen the paper and he probably got so many comments already. Okay, so what I'm going to do in this discussion is I'm going to put on a hat of international finance, and I'm trying to put the paper in the context of what other people have done already in international finance. And in particular, I have two comments. So in my first comment, I want to relate the paper to what in international finance we call the exchange rate disconnect puzzle. And in my second comment, I want to zoom in on this European debt crisis, and I want to argue that what the drivers are of the spread that we observed at the time. Okay, so let me very briefly summarize Ralph's paper. So what's the main idea? The main idea is that they want to ask what are the main drivers of international asset prices. Now, of course, there's a large literature in international finance that asks what are the global factors that drive the factor structure of exchange rates. So Hanno has papers, Adrien has papers, and what the consensus view is that there are two global factors which we call dollar and carry, which explain 100% of the variation of exchange rates. Now, what does this international finance literature do? Usually is what they do in order to extract these factors is that they only look at the cross-section of exchange rates, and they're going to extract these factors using a no arbitrage approach. This is not what Ralph and Motto are doing in their paper. So what they do in their paper is that they have this demand system asset pricing approach. So they not just look at prices, but also look at quantities. At the same time, what they do is that they not just focus on exchange rate, but they also focus on short-term, long-term debt and equities. Now, why is this important? So I started working on this topic myself, and I actually never realized, because all the previous literature only always looks at exchange rates itself, I never realized how important it is to actually also look at equity and debt in order to understand the variation in exchange rate. Why is it important? Well, because if you're a Swiss investor and you want to trade a US asset, there's also, for example, an exchange rate when you trade US equity. Again, I never thought about this context. So what they do in this paper is that they want to try to understand what are the common factors that not just drive exchange rate, but also equity and debt. Okay, so in their paper, asset prices move because of three things. The first thing is demand of global investors, which depends on macro fundamentals, supply of debt and equity of firms, and policy. Now, of course, there are a million papers that study the effect of monetary policy announcements on exchange rates, for example. There are also some recent papers that look at the effect of supply on exchange rate. What's new in this paper is that they bring in this demand. Now, the way it works is via this market clearing condition. So on the left-hand side, you have supply. So PT is the market to book value of assets in country N for asset L. ET is the exchange rate, because everything is in the local currency. You want to determine everything in one currency, which is the numeraire, which is the US dollar. QT is the book value of assets, and on the right-hand side you have demand. So AI will be investors' wealth, and WIT is just the portfolio weight of investor I in asset N. Okay, so what's the main finding? So of course, I have many empirical findings in the paper. I just want to focus on this table here because this is what I'm going to discuss. So what they found is that exchange rates, the main determinant of exchange rate are macro variables, which are 26%, short-term rates, which are 8%, and then you have reserves and latent demand. And they have a similar decomposition for debt and equity. So what I want to do in my discussion is I want to discuss these two numbers here, the 26% and the 8%. And when I first read this paper, I was very surprised by these two numbers. The reason being, because as I said, in international finance, we have what we call an exchange rate disconnect literature, which argues that there's no connection between exchange rates and macro variables. The reason why I'm surprised by the 8% is because this is a very low number. Okay, so whereas this number is very high, I find 8% very low. The reason being is because if we think in terms of no arbitrage, okay, so if we go back to all this literature that imposes a no arbitrage condition or extracts stochastic discount factors from the cross-section of exchange rates, if you impose no arbitrage, UIP should hold and short-term rates should explain 100% of exchange rates. But this is not the case here. Okay, so I want to discuss these two numbers. Okay, so as said, my first comment would be exchange rate disconnect. Okay, so what is the exchange rate disconnect? So as I said, what Ralph and Moto find in their paper is that a significant fraction of the variation in exchange rate is driven by macro variables, and this is very surprising given the international literature on exchange rate disconnect. So what is the exchange rate disconnect? It's the general view that we have in international finance, which argues that exchange rates follow a random walk, which is not correlated even contemporaneously. So there's no way that you can predict exchange rates, and there's also no correlation contemporaneously with macroeconomic fundamentals such as output, inflation, import or exports. And there's, since this has been documented in the 1970s, there has been like a million papers that try to show that. If you take more recent data, what I do here is that I just plot real exchange rates against consumption growth in different countries. So you have US, Eurozone, Australia, and the UK, and if you just do a simple scatter plot, so this is monthly data and this is much longer time series, you see that the correlation is basically 0. Okay, so what have people done in international finance? So people were very frustrated by the fact that there's this disconnect between macroeconomic fundamentals and the exchange rate. So what people have done in international finance is that they have started looking at financial variables. Okay, so Zhen Yang has a paper where they show that there's a connection between convenience yields and exchange rates. And then there's another paper by Matteo and others where they show that what we call global risk proxies, such as the Gilchrist-Zacharias spread or intermediary capital, has a relationship to exchange rate, particularly after the 2008 crisis. Now, why do we believe that financial variables should matter? Well, it matters because exchange rates are different from equity and bonds. In the way that exchange rates are different from equity and bonds is that the exchange rate market is mostly over the counter and it's intermediated by a few players. So if you, for example, look at the summary statistic of how many percent of the foreign exchange market is traded by particular players, what you see here, the 10 largest players in the world are these banks or financial institutions, and these financial institutions trade over 60% of the foreign exchange trading volume. Okay, so this is very different from what we see in the equity and bond market. Now, what is particular about these financial intermediaries? Well, these financial intermediaries, the reason why I cannot just go and trade a Swiss bond and I have to go via UBS is because these intermediaries provide a service because these markets are thought to be segmented. Okay, so there's an argument that people make that there's a large segmentation, even though these are very liquid markets, there's a large segmentation between short-term bond markets, for example, in Switzerland and short-term bond markets in Japan. And indeed, this is, for example, also what Ralph finds in his analysis. What he shows is that, for example, distance matters. Okay, so the further I am from a specific country, the harder it is to trade the specific asset. So what these intermediaries do is that they intermediate the demand of two different countries for example, short-term bonds. And the reason why this is very attractive in international finance is because this explains the disconnect puzzle. It explains the disconnect puzzle because these intermediaries are, of course, UBS is very disconnected from the consumption growth in Switzerland, and hence this explains why the correlation between consumption growth in Switzerland and the Swiss franc can be very low. Now, what is particular about these intermediaries? So these intermediaries all face different frictions. Okay, so in the paper of Xavier and Matteo, what they have is a value at risk constraint. And of course, there are many also different trading costs which contribute to the segmentation that we see across these different markets. And what I want to convince you of is that these frictions are potentially very large in even very liquid markets. So just to give you a flavor, so what I plot here is the average bid-ask spread of exchange rates, and these are just the largest 7 exchange rates that we have in the world. Okay, so what you see here is that, for example, these bid-ask spreads can be massive. Okay, so what you see here, for example, for the New Zealand dollar, these bid-ask spreads can be up to 40 basis points. Of course, they all went down over time, but still, on average, they're around 15 basis points, which is very, very big for a market that is the largest market in the world. If we go to short-term bond markets, what I plot here is just the average bid-ask spread between short-term bonds across these 7 large countries. And what you see here is also that transaction costs on short-term bonds are also pretty big, right? It's 2 basis points, but these are, I mean, the interest rate on short-term bonds is basically 0. Same for long-term bonds. So if you look at, this is just for the US, it's very hard to understand what transaction costs are on long-term bonds. What you see here is that these transaction costs can also be big. So for the 10-year US Treasury, we have around 4 basis points. For equities, I was also very surprised. So you would think trading the MSCI Switzerland would be very cheap in terms of transaction costs, but if you look at the bid-ask spread, so I couldn't find the data on the MSCI, I had to take ETFs. If you look at transaction costs, they're actually also pretty big. They're around 14% on average. Okay, so what is the point here? So the point here is that these transaction costs are pretty big, which contribute, of course, to the segmentation across even very liquid markets. Okay, I'm not talking about the Philippines and the US. I'm talking about, say, Switzerland and the Eurozone. Now, what currencies or what exchange rates do intermediaries actually trade? So if you go to the BIS statistic and you just look at how much gets traded across different exchange rates, what you would find is that if you look at the 10 largest exchange rates, almost all turnover, 180%, because the maximum is 200, is basically traded in 10 currencies. What Ralph and Motto are doing is that they look at 35 different exchange rates. So you have very exotic exchange rate like the Colombia, Thailand, and the Philippines. So what am I trying to say? So what I'm trying to say is that what they find in the paper is very surprising if you come from international finance, which tells you that there shouldn't be any connection between the macro and exchange rate. Now, of course, his findings give us a lot of hope because there seems to be a connection between the two. It's just that when we usually look at financial variables or these intermediary stories, we kind of miss something that Ralph and Motto are bringing to the table. And what I would like to understand is, like, what are other models missing that we cannot find this correlation, whereas they find this very high correlation? The second point is that these frictions are pretty big, even if you look at very liquid markets, and these frictions are probably going to contribute to a large segmentation and violations of no arbitrage. Now, if you take the demand systems approach, different from the no arbitrage approach that Hanno and others have been doing, is that if you do not impose the no arbitrage condition, what you should find is that short-term rates should explain a lot of the variation, but Ralph finds it explains very little of the variation. So how is their approach, again, different from what we do usually when we do the no arbitrage condition? Perhaps everything I told you is just captured in this latent demand, which is unrelated to fundamentals, but I would like to understand better what is happening. Okay, so then I come to my second comment for the last couple of minutes, which is I would like to zoom in on the European debt crisis. So again, here's the yield spread decomposition. What they find is that, for example, a significant fraction of the yield spread that you observe between Greece and so-called core countries is driven by the macroeconomy. Now, working on it myself, again, I was a little bit surprised because I thought how I understood the data is that there's actually, again, very little correlation of what we see in terms of yield spreads and macroeconomic fundamentals. So just to give you an example, the Financial Times had this quote which says, the European debt crisis has little to do with fundamentals. There are plenty of money managers who fear that part of Europe's core, which would be Germany and France, are almost as rotten as the periphery. What I plot here is the yield spread between the periphery and core countries. Here's GDP growth between Germany and Italy, and here's inflation. Now, what you see here is that the differential between the two is actually not that big, which is kind of surprising. So if you plot the GDP growth spread against the yield spread that these countries have, you see actually that the correlation, again, is pretty weak. So what have people argued drives the spread between yields in the core and the periphery? Well, it's monetary policy. If you just sort the yield spread between periphery and core, and you just look at the largest decreases in the yield spread, what you see here, the red bars, are announcement by the European Central Bank. And what you see here is that 3 out of the 5 largest decreases that you see in the yield spread are on dates that the European Central Bank was announcing unconventional monetary policy. But however, unconventional monetary policy is not about fundamentals, it's about people's expectations about the fundamentals. Okay, so again, echoing of what I said in my first comment, the fact that we find that macro drives these yield spreads is surprising because I would think that it's more expectations that matter rather than fundamentals themselves. Okay, let me summarize. It's a great paper. I learned a lot reading it. It really makes a big step towards our understanding of drivers of international asset prices. However, I would obviously like to understand better where these results are coming from. Thank you very much.
Thanks very much, Andrea, for that great discussion. Let me see if there are any hands up. While people are getting ready to get their hands up. So Ralph, I mean, I think this is a really very important paper for the literature. We've been studying it very closely, not least because of of our work on the risk-taking channel of exchange rates. And for us, this is more about the dollar. Rather than, so it's really about the broad dollar index rather than the multitude of different bilateral exchange rates. And Valentina, Bruno, and I have pushed this line that it is the broad dollar index. But there's also this paper, in case it's not registered on your radar, by my colleague Boris Hoffman, which shows that the broad dollar also has an impact on macro variables. That was in the latest quarter review. So I guess for you, Ralph, while people get their hands ready. Oh, Dimitri's there. Good. Well, let me get my question in, and then maybe I can go to Dimitri, which is it about the US or is it about the dollar? Because those are we'll see Pierre Olivier's paper later as well. I guess that's that's the distinction that I'm sort of puzzling over. Dimitri.
Okay, yeah, my question is about this, the connection between kind of short rates or macro fundamentals and latent demand, and builds a little bit on what on Andrea's comments. So I would like to know whether there is any kind of connection between at different lags, let's say between the short rate, let's say there's a short rate change this month, whether this can affect latent demand in the future, and perhaps some of the effects that are attributed to latent demand in the variance decomposition might be reflecting policy variables, but that operate over a different time horizon. Okay.
So Ralph, why don't you take those and any responses to Andrea as well?
Okay, great. Well, these are great questions, and let me first thank Andrea for like a very nice discussion. So I'm going to try to quickly sort of make respond to them. So one is on the sort of exchange rate disconnect. So in during this sample, if you run just bilateral regressions, reduced form, you will also find a fairly high R-squared. Now, what is different from the demand system vis-a-vis those reduced form regressions is that if you run those reduced form regressions for like equities, for currencies, and for long-term bonds, the signs go all over the place, and so it's very hard to interpret those variables. In the demand system, you get sort of like what we think is sort of like interpretable sort of coefficients that are stable across asset classes. The second thing is sort of the model does like what, sort of just a technical point, but like the model does not admit arbitrage because like you have dependence on like expected returns. If there would be arbitrage, expected returns would be infinite, and as a result, sort of like you would sort of like close that gap. So you could have like a low correlation with short rates and have UIP hold because of course it could be like unexpected shocks to exchange rates in the future. But the part that I think is really important is on intermediaries, and we would love to sort of like model that part better. It's really a data restriction in many ways. So the way to think about it is that you're estimating a combined demand curve. Like so if let's say the Netherlands goes like invest in the US, it has to go through like intermediaries. You're sort of measuring the combined demand curve like once you go through those intermediaries. What would be really great is if we would have this aggregated data on what intermediaries are doing and the frictions that you have there, but we simply do not have these data. In terms of like to Dimitri's point and Andrea's point about sort of like what is latent demand, what about expectations and dynamics. So you're absolutely right that like latent demand and the macro variables for that matter as well. Those are like the way to think about it is that they tell you something about expected growth, or they could tell you something about expected policy in the future. There's nothing sort of that like rules that out. And so we haven't done that yet. We have done that in sort of our earlier work, but you could sort of think that like the latent demand should tell you something about expected future growth that is not captured by those macro variables. And so the thing that's interesting is that if you do it for like the cross section of US stocks, like in our earlier paper, it's almost all latent demand, and that does forecast future fundamentals in the cross section. Now, if you sort of go to at a country level, actually latent demand is like smaller, which is kind of interesting. So you can at least sort of explain more with those with the macro variables. But of course, they're telling you something about future growth and things like that. And so sort of doing dynamics, that's obviously sort of like on our agenda, but it's much more challenging. To sort of to Hugh's question about the role of the dollar versus like the US. So there's a couple of things we could do. I think sort of like if there's a dollar index that we can sort of build within our model, one of the things that could potentially be interesting is to understand what drives fluctuations in that dollar index, like which investors sort of like demand shocks and fundamentals sort of like explain that. Now, to what extent it's about the dollar versus the US, there's a bit of a data challenge here. So what we know, of course, for every country is like, for instance, emerging markets, we know what they issue in terms of like local currency versus like dollar. What we do not know is the holding site. So we know that sort of someone, I don't know, let's say UK investors may hold a certain amount of like Brazilian assets, but we do not know whether it's a local currency or dollar. And so unless we have that data, we wouldn't know. Now, there's some progress we can make using, for instance, the work that like Matteo and Brent and Jesse have done using sort of mutual fund data to sort of see like whether we can sort of like improve on some of that measurement, which we plan to do. But I think that's the main sort of like obstacle that you would have in terms of like going from US only to dollars, simply because you do not have that data, I think, at this point.
Great, thanks. Pierre-Olivier?
Yes, hi everyone. I'm a big fan of this paper. I think it's really a very nice exercise. Just a quick question that goes back to Andrea's point on the disconnect. I mean, in the international finance literature, and I think this is a point I already made to the authors, but I'm curious to hear their answer. There's a long tradition of models that sort of perform pretty well in sample, but perform pretty poorly out of sample. And that's a sense in which, it's hard to explain exchange rates. is, you can find, looking back, you can sort of find a constellation of drivers that seem to work, but once you look out of sample, it sort of totally falls apart. I know you have a relatively short time period here, but have you looked at whether you could estimate your demand system on, say, the first 10 years and then project for the next 5 years, and tell us whether you still find that you have predictability based on the fundamentals that is reasonable?
Right. So we haven't done it for this paper yet. We will, but we have done it for our earlier paper, sort of in U.S. equities, and sort of asking the question: are demand systems sort of stable over time? And sort of it also relates back to the question in terms of like predictability. And so what we found there is that if you estimate, so there we have like the luxury of like having a very large cross section, so you can estimate it literally like quarter by quarter. And then you see that sort of the demand coefficients are actually very stable over time. And in addition, you can actually sort of use it to forecast future demand as well. And so the exercise you're suggesting in terms of like I don't know, using the first part of the sample or leaving 1 year out and see how well it explains is something we can certainly do. Yeah. And also let me say one small thing in addition to that. Like for us, like another question that sort of and then again, like it may be too ambitious, but we'll try. Is to sort of see, like, if we go through the COVID crisis, I think, like, if you're sort of, I don't know, if you're a central bank and you're sitting in March of last year and you're trying to assess, like should I sort of like buy government bonds, should I buy corporate bonds, or perhaps even intervene in equity markets? Like, how much would I move prices? And what is the impact on my exchange rate? You would be looking at sort of like event study estimates that are out there, which are done for like one announcement for the US when no other central bank acted and things like that. And so in that case, sort of like we think sort of like a really sort of interesting out of sample test would be to feed in sort of like the shocks coming from central banks all over the world last year, and see how well the model can sort of explain exchange rates, long-term bond prices, and equity prices, and compare that to alternative models that we have out there. If you would be in the position that you would have to sort of assess like how effective was QE during that period, during that sort of simultaneous shock.
Thanks, Ralph. I think that I don't see other hands. I think you've put us on a very good path for this whole session. I think that was a very stimulating presentation and discussion. We're going to take a small break now. So I see Hanno joined us already, but we're going to be resuming at 4:05 Basel time, 3:05 London time. So go and get a cup of coffee. But I'll start the session sharp on at 4:05. And I think we have a couple of very good papers coming up. Okay, see you shortly.
Thank you. Let me start by thanking the organizers for giving us the opportunity to present. This is a paper on convenience yields beyond incomplete spending. Convenience yields and exchange rate disconnect, joint work with Xinyang Jiang, who's at Northwestern, and Arvind, my colleague at Stanford. Let me start by giving you an outline of what I'm going to talk about. First, I want to outline sort of the link between exchange rates and interest rates, sort of a large class of standard models, and then I'm going to introduce the convenience yield channel that we want to focus on in this paper. This is a novel channel through which central banks, particularly the Fed, can affect the dollar exchange rate by manipulating convenience yields through large-scale asset purchases. And then I want to talk about how this model could potentially explain sort of help explain three outstanding exchange rate puzzles. And then I'm going to proceed by sort of describing in broad strokes the model. So here goes. Let me start by reminding you what the relation is between exchange rates and interest rates in a large class of models. The dollar exchange rate is going to reflect future interest rate differences, future currency risk premia. As news about future interest rates is revealed, the dollar exchange rate is going to adjust. If there's news that future short rates in the US are going to be higher, the dollar exchange rate is going to appreciate. If there's an increase in the currency risk premium that foreign investors want when they're taking long positions in dollars, that will cause the dollar to depreciate. So that's kind of the framework that I want you to think about. Now, if exchange rates are stationary, let's just look at that world for a second because it makes things simpler, then you can show by substituting out for the short rates in this equation that you end up with the following expression for the dollar exchange rate. Now what you have on the right-hand side is the long yield, let's say the 20 or the 30-year yield gap between the dollar and foreign currency yields. You're going to have deviations from the expectations hypothesis. These are local currency bond risk premia abroad and in dollars. And you're going to have the short-term currency risk premia, the deviations from short-run UIP. Now, what you can show is that when exchange rates are stationary, these last two terms will exactly cancel out. And that's kind of intuitive because of longer holding periods. In this case, foreign domestic bonds are sort of equally risky. And so you get a version of long-run UIP that is the dollar exchange rate is just going to be pinned down by the gap between yields in the US and yields abroad at the very long end of the maturity spectrum. That, of course, opens up a channel for central banks to affect exchange rates by changing the long yields. And that's exactly what Pierre-Olivier will talk about in the next paper. They analyze a model with segmented bond markets based on work that Dimitris has done previously. In this class of models, you see downward sloping demand curves for treasuries. And so what's going to happen is that if you have a decrease in the net supply of bonds, you get smaller local currency bond risk premia in the US. That's going to pull down the dollar yield, and that's then going to cause a depreciation of the dollar exchange rate. So that's sort of what I would call the bond risk premium channel for QE. We're going to outline a distinct channel that operates through the convenience yield. So when there are convenience yields to be earned by foreign investors, and this is the connection with what Rolf was talking about, and I'm going to denote these convenience yields by lambda dollar. So these are convenience yields earned by foreign investors who take a long position in US dollar bonds. That leads to an amendment of that fundamental exchange rate valuation equation. Now, the dollar is not just going to reflect future short rate differences and future currency risk premia, but also future convenience yields. We can infer these convenience yields from CIP deviations in treasury markets. So I'm going to use XD here to denote the basis in government bond markets, where you're essentially comparing yields on a cash treasury to the yield on a synthetic treasury that you construct from, say, taking a German Bund and hedging the currency risk. Okay. The larger, the more negative that basis is, so the lower the dollar yields compared to the synthetic yields on the foreign bond, the bigger the convenience yield. Now note that the basis does not capture the entire convenience yield. It's just a fraction of it. In fact, the actual convenience yields that we estimate in our previous work are actually almost an order of magnitude larger. So that's the fundamental exchange rate valuation equation when you have these convenience yields, and that obviously creates a sort of a novel, we call it convenience yield channel for large-scale asset purchases holding fixed interest rates and short-term currency risk premium deviations from UIP. Central banks, in particular the Fed in this case, because this imputes kind of a unique role to the Fed. In this model, the only bonds that earn convenience yields are US dollar denominated treasuries. The Fed can manipulate these convenience yields potentially. For example, suppose the Fed were to buy long-dated treasuries, that could cause these convenience yields to increase and the dollar to appreciate. Similarly, the Fed could buy mortgage-backed securities and issue reserves, and that could cause convenience yields to decline and the dollar to depreciate. So the exact effect would depend on the nature of large-scale asset purchases and how these asset purchases affect the convenience yields, of course. And it's an issue I'll come back to in a second. But that's the channel that we have in mind in this paper, the channel that we want to explore. What we want to do is develop a fully specified no arbitrage model with convenience yields. We want to use that model to sort of see if we can make progress on 3 outstanding puzzles that I'm sure this audience is intimately familiar with. Just to remind you, if we had sort of your benchmark neoclassical complete markets model, then the dollar exchange rate appreciation would just be equal to the difference between the log pricing kernel in the US and the log pricing kernel abroad. And we know that that equation gets us into quite a bit of trouble. First, it implies volatility of exchange rate changes that is much too high. We know that from the Hansen-Jagannath bounds, the volatility of M and M star is at least on the order of 50% per annum. And so what you would need is a very high, almost implausible correlation between domestic and foreign pricing kernels in order to be able to get the volatility of exchange rates to be in the plausible region of around, say, 10 to 15% per annum. So basically, this equation implies exchange rates that are just too volatile. Exchange rates have to do a lot of work here because they absorb all these SDF shocks. In addition, and this goes back to work by Coleman and Backus and Smith, it sort of applies these counter-cyclical exchange rates that appreciate, so the dollar is going to appreciate when there's a bad shock in the US that pushes up the growth rate of marginal utility in the US relative to marginal utility growth rates for foreign investors, which also seems counterfactual, particularly when you plug in sort of your standard Breeden-Lucas stochastic discount factor and confront this with consumption growth data, for example. Obviously, that's the exchange rate disconnect that Andrea was referring to in her discussion. So, and in addition, of course, there's sort of the risk premium puzzle. I've done some work with Adrien Verléan, where we try to sort of look at whether just introducing market incompleteness is going to allow us to make progress on these. And the conclusion there was that it helps. It certainly helps to have these sort of incompleteness wedges in there that allows you to make progress on the volatility puzzle. You can't quite flip the sign on that correlation, though, and the risk premium puzzle worsens. So the agenda here is to see what happens if we combine market incompleteness with convenience yield. So if you go and look at foreign investors' Euler equation, so here M star is the foreign pricing kernel, R star is the foreign risk-free rate. That is the first Euler equation for the foreign bond investor. The foreign bond investor can also invest in US treasuries. That's that second equation. We're going to introduce these eta incomplete market wedges. So when markets are complete, these eta wedges would be 0. They would just drop out. But market incompleteness allows for a gap between, in logs, the foreign and the US marginal utility growth rate. So we're going to use that. And in addition, we're also going to have an Euler equation wedge, which we call the convenience yield. This is very much in the spirit of recent work by Oleg Ichkoki and Dmitry Mukin. So that's basically the setup. We're going to bring incomplete market wedges and Euler equation wedges together. We're not going to have market segmentation. So that's different from the paper that Pierre-Olivier will talk about. So we're going to shut that down. Markets are not segmented, but foreign investors earn Euler equation, earn convenience yields, and that introduces an Euler equation wedge. So let's see how far we can get with this. Here's the actual model. The actual model is set up in continuous time. Here is the continuous time version of the Euler equations that I was just showing you. So first, just to remind you, in our model, domestic investors don't earn convenience yields when they buy US bonds. So by domestic here, I mean US investors. Foreign investors, on the contrary, they will earn convenience yields on their holdings of US bonds, and these convenience yields are denoted lambda tilde. So that flow convenience yield enters into the pricing condition for the dollar risk-free asset for the US Treasuries. Pricing kernel dynamics are fairly standard. They're going to follow standard diffusion processes. We set this up such that exchange rates that come out of this in the complete markets case are going to be stationary. That's why for M star, we have that phi S term in there that sort of allows us to keep exchange rates stationary, which is going to help us later on. We have a separate process that governs the dynamics of the convenience yields. And then we're going to assume, in particular for foreigners, that there's sort of foreign flight to treasuries, so that when there's a shock that causes marginal utility growth to go up abroad, M star, that also leads to larger convenience yields being earned by foreigners on their holdings of US domestic bonds. That's going to be a key feature of the model. That means that our rho star, is going to be less than 0. Rho star is the correlation between the Brownian driving the foreign pricing kernel and the Brownian driving the convenience yield process. So that's the flight to treasury channel. What we get then is, and this is the continuous time equivalent of that equation that I just showed you, that present value equation. The log of the exchange rate is going to reflect future short rate differences, future currency risk premia, deviations from UIP, and also future convenience yield. So everything is going to be reflected there. Pi denotes the sum of the currency risk premium and the convenience yield in logs, so that you see that 1/2 lambda tilde term in there, and then the other term is the currency risk premium in logs, which I'll come back to in a second. We obtain closed form expressions for these. What drives exchange rate dynamics here? Well, remember, we have incomplete market wedges, first of all. So we have these eta wedges that I was showing you in the discrete time introduction. They're going to drive a wedge between the foreign and the domestic pricing kernel. And that's reflected in the dynamics of the exchange rate. So beta here is going to govern how far you are away from the complete markets case. It governs the degree of incompleteness. A natural case to look at here is the case where beta is 1 and gamma is 0. Then you're back in sort of your standard complete markets model, where the exchange rate is just in logs, the difference between the US and the foreign pricing kernel. As soon as you push beta away from 1 down, you see that you're sort of introducing larger and larger incomplete market wedges. These wedges now are going to absorb part of the SDF shocks, and they're going to help us to keep volatility in check, as I'll show you in a second. Gamma controls the impact of the convenience yields of these Euler equation wedges. So we have these two forces. Given that markets are incomplete, there are many equilibria here, and they're indexed by beta and gamma, right? So there's a whole bunch of equilibria indexed by beta and gamma that we can look at. And as I mentioned, we have closed form expressions for these. To develop some intuition for how this model works and what it can do, we're going to look at a calibrated version of this model and use it as a laboratory. We're going to pick the volatility of the pricing kernels to match the Hansen-Jaganathan bound. So we're going to start with volatilities of 50%. We're going to assume that the foreign and the domestic pricing kernels are uncorrelated. We'll embed this foreign flight to treasuries in our model. So that's captured by that rho star correlation. Remember, that's the correlation between the pricing kernel and the convenience yield that foreigners earn on their holdings of US treasuries, so that when there's a bad shock abroad and their pricing kernel's higher, that's going to drive up the convenience yield they earn on US Treasuries. And then finally, we're going to pick parameters to sort of match the facts we documented in our other paper for US convenience yields. This is very much in line with estimates of Ralph and Moto. The average convenience yield here is going to be about 2.5%, so it's quite large. That's what foreigners earn on their holdings of US Treasuries, and the standard deviation is 2.1%. So let's sort of see how well the model does. We're going to look at a couple of sort of key facts that we can compute in the data. So beta, remember, is that parameter that governs how far away we are from the complete markets benchmark. If I push that all the way to 1, then we're back in the complete markets case, and that model obviously is going to not do very well. It's going to imply exchange rates that are just much too volatile, given the volatility of the pricing kernel. What's the sweet spot here? When we push beta close to 0, obviously. So let's look at the case of where beta is 0.1. The column 2 that you're looking at there, that number is the slope coefficient and regression of the change in logs and the dollar exchange rate on the change in convenience yields and the data. That slope coefficient is between 1 and 1.5. In our model, that's about 1.7 when beta is 0.1. We come pretty close to matching the volatility of the dollar exchange rate. It's about 11.9%. It's a bit higher than we have in the data. And if you look at a regression coefficient of the change in the dollar on M minus M star, this goes back to that Backus-Smith puzzle that I showed you, this countercyclical feature. We can't quite flip the sign on this, but we can push that number quite close to 0. Remember, in the complete markets case, that slope coefficient is 1, right? You get perfectly countercyclical exchange rates. So we do quite a bit better there, and we generate a very negative average return on going long in treasuries. That's not surprising. That's just because of that large convenience yield. So that last column is just the expected return for foreign investors who take a long position in treasuries. What's going on here? How does this work? Let me use the last few minutes to explain how we make progress on this. So if you look at exchange rate volatility here, the expression for the conditional variance of exchange rates is given here. Remember, gamma captures the effect of convenience yields. Beta sort of measures how far you are from the complete markets case. If you look at the case where beta is 1 and gamma is 0, then you're back in complete markets. And then that conditional variance is 2 sigma squared, which would be, of course, in this case, a number that's very high. Remember, sigma is about 50%, so that would be much too high when you compare it to the volatility of exchange rates. By pushing beta down away from 1, we can actually significantly reduce the volatility. What happens here is that these incomplete market wedges absorb part of the stochastic discount factor shock, so the US dollar doesn't appreciate as much when marginal utility growth is higher in the US than it is abroad, and we get an additional sort of assist from the convenience yield channel. Remember that rho star is negative, and that sort of also pushes the volatility down. You get reverse flight to treasuries when M is higher than M star. The lower convenience yields then cause the dollar to appreciate less than it would otherwise have appreciated. So both these channels help to reduce exchange rate volatility relative to the complete markets case. What about the slope coefficient in a regression of delta S on M minus M star? In the complete markets case, this is 1, and that's that countercyclical exchange rate, the Backus-Smith-Coleman puzzle. In incomplete markets here, by pushing beta down, we can also get this slope coefficient down. In theory, when you study this expression, I'm not going to bore you with the algebraic details, but you can actually, in theory, show that it could be negative. In practice, when we plug in numbers, we get it to be much closer to 0, but we can't get it to actually flip the sign. That's that second result that I showed you here in column 4. We get a number of 0.1 in column 4, which is much smaller than complete markets case, but we can't quite flip the signs. And the Backus-Smith puzzle is a really resilient puzzle in that sense. And then the last thing I wanted to show you is the currency risk premium. The currency risk premium, the expected return on a long position in dollars in levels, is given by minus lambda tilde plus beta sigma squared plus that residual term. Complete market benchmark, beta is 1, gamma is 0, then you just get sigma squared. It's completely a Jensen's inequality effect in logs. The currency risk premium in the complete markets case is 0 because we're actually looking at a completely symmetric environment where the foreign and domestic pricing kernel volatility are the same. We obviously get a large negative expected return on dollar bonds because lambda star is on average about 200 basis points. So that's what's driving that result. In the interest of time, let me actually skip these plots, which just give you a graphical representation of these results, and to briefly conclude by talking about the convenience yield channel. So if you look at the data and you look around QE events for the Fed and you look at the change on the horizontal axis in the 1-year treasury basis, on the vertical axis, we plot the percentage change in the dollar, the appreciation of the dollar. What you see is, first of all, that sometimes the basis widens, becomes more negative. Sometimes the basis narrows, it goes up then. So you move to the right as the basis narrows, you move to the left as the basis widens. But there's a pretty tight relation with the dollar. The strong negative relation, that's exactly consistent with the model. So, and this is controlling for changes in interest rates, right? So this suggests that changes in the basis, capturing changes in convenience yields are pretty powerful determinants of what happens to the dollar around these events. And so if you compute the impulse response function, and this is my last slide, for the dollar exchange rate to convenience yield shock, what you get is that panel in the lower right-hand side. So that shows you the impact of a 1 standard deviation shock in convenience yields to the dollar exchange rate. The dollar exchange rate here appreciates by about 1%. How does that compare to the numbers we see in the data? Well, it's a bit smaller. It's a sizable effect, but a bit smaller than in the data. So let me conclude here. I'm out of time. What we've done here is outlined a novel convenience yield channel through which large-scale asset purchases can have an impact on the dollar exchange rate, holding fixed interest rates and everything else. Thank you.
Great, thank you, Hanno. Perfectly on time. Let's go to Tony. The discussant is Tony Zhang from the Fed.
Hello, can you hear me? Yes? Okay.
Thanks.
I assume that you guys can hear me. Thank you very much for giving me this chance to discuss this paper. Yeah, so as my name is Tony Zhang, I am from the Federal Reserve, so of course the usual disclaimer applies. Okay, that disappears. Good. All right, so I'm gonna start by just saying, where do I think this paper fits into the literature? In the recent years, there's kind of been this like proliferation of papers that have tried to introduce stochastic wedges into multi-country models, into different investors' Euler equations to try and resolve some exchange rate puzzles. And overall, this branch of literature has been relatively successful in characterizing exactly what we need out of these wedges in order to finally understand, make some progress in understanding these exchange rate puzzles. Now, recently, the same set of co-authors, Zhang, Krishnamurthy, and Lustig, they've written this paper that's shown foreign investors, they derive a convenience yield on the holding of dollar bonds, dollar assets, basically coming from the liquidity or safety properties of a US dollar. And as a result, these foreign investors, they have this naturally stochastic wedge in their Euler equations that represents their demand for the safety and liquidity properties of dollar-denominated assets. So a natural question to ask then is that if we introduce this dollar convenience yield calibrated to match like the demand from these foreign investors, if we introduce this convenience yield as a stochastic wedge into investors' Euler equations, can that help us understand these exchange rate puzzles? And what the authors find, of course, in this paper is, yes, it does help along a number of dimensions. Now, in this discussion, I'm going to proceed first by providing a simplified version of the model that the authors have to really try to boil down what are the key assumptions that the authors need to make some progress in understanding exchange rate puzzles. Afterwards, I'm going to provide a couple of comments. I should start off by saying that I've done a little bit of work in this area, and so I really like this paper in the sense that it provides a very nice extension of the earlier work, and also helps us really understand how exchange rates and convenience yield kind of interact together. And so what I really want to do in my discussion is, one, provide some clarification for maybe some of the results, and also clarification for some of the ideas that the authors present, and thinking about what exactly is a convenience yield. And afterwards, I want to try to expand the ideas in this paper a little bit and think about whether or not we can use some of what we learned about the convenience yield or the movements of the convenience yield over time to think about other types of puzzles in the broader macro finance literature. Okay, so first, let me start off with a simple model. Again, the key idea is that I'm presenting this static model to just highlight the key assumption needed to address the asset pricing puzzles that the authors tackle. So again, you have two countries. There's only two time periods now, t and t+1. Basically, this simple model boils down to these two equations. You have an Euler equation for investment for the foreign investor, where the Euler equation says the expectation of, again, the stochastic discount factor, represented here by the ratio of marginal utilities of the foreign investor, multiplied by the expected exchange rate appreciation, multiplied by the risk-free return on the dollar asset, is going to be equal to e to the minus lambda t, where this lambda t here is the convenience yield. Essentially what happens, how this works, is that as long as you have a positive convenience yield, positive lambda t, foreign investors are going to accept a lower rate of return on their dollar-denominated assets. The second equation that we need is basically that US investors do not obtain any convenience yield, or more generally, they obtain a smaller convenience yield on holding dollar assets. But for simplicity, they don't obtain any convenience yield here. All right. Now, if you take these two equations, you assume that the marginal utilities, these xi's here, they're log-normally distributed IID. You assume that the exchange rates are log-normally distributed IID. You can do a little bit of algebra that ultimately shows this equation down here. I'll try to make my face disappear. Okay. You can show that the exchange rate today is equal to the difference between the risk-free rates of the two countries, represented here in the difference in their marginal utilities, expected marginal utility growth. There's a component here that captures currency risk premia. There's the expectation of the exchange rate tomorrow, and then there's also the dollar convenience yield. All right. So what do you see? When the dollar's convenience yield lambda t increases, that's going to increase demand for dollar assets. That's going to increase ST. ST is the exchange rate, how much foreign currency needed to purchase a US dollar. So you're going to have an appreciation of the US dollar. All right. So what are the assumptions that we need now? The only assumption that you really need is that you assume the covariance between the foreign investor's marginal utility, xi t star, and the convenience yield is something positive, such that in the bad states of the world, when marginal utilities are high, foreign investors are going to fly to safety and they're going to demand more dollar assets. How does this help with all these asset pricing puzzles? Well, typically, if you look at the foreign investors' marginal utility, foreign investors' Euler equation, whenever the foreigners have high marginal utility, okay, it used to be the case without a convenience yield that their foreign currency would need to appreciate to keep investors on their Euler equations. However, now with a convenience yield, if the foreign investors' marginal utility increases and their convenience yield increases at the exact same time, that increase in the convenience yield is going to cancel out some of the increase in the marginal utility so that the exchange rate doesn't need to respond nearly as much. Another way of thinking about this intuition is that if the foreigner's marginal utility increases, typically we expect this ST, this ST to decrease, the foreign currency to appreciate. However, if you have the lambda T increase, convenience yield increase at the same time, that's going to dampen this ST movement. All right, so that's basically it. You're gonna get a smaller pass-through of these marginal utility shocks, of these SDF shocks onto exchange rates, and it's going to be directly proportional to how much convenience yields co-vary with marginal utilities. Because you have this dampening of the pass-through of these SDF shocks onto exchange rates are going to be smoothed out a little bit. You have a lower volatility of exchange rates. And of course, you're also going to help break this Backus-Smith puzzle, breaking this tight link between changes in marginal utilities and exchange rates. Each of these, of course, is going to be proportional to the psi t here, which is how much do convenience yields co-vary with changes in marginal utilities. Now, if you look at the data, is this something that's likely going to, the data is going to likely show? Well, the obvious answer is yes. Here I've plotted the dollar convenience yield over the last 20 years or so. And indeed, you see that dollar convenience yields do tend to increase in the states of the world when foreign marginal utility is high. And most notably here, you see this large spike during the global financial crisis. So is this the whole paper? Obviously not, right? I've kind of shown a qualitative illustration of the mechanism why we might suspect that calibration where we calibrate stochastic wedges to convenience yields might help with asset pricing puzzles. In the paper, the authors do a lot more to try to understand the quantitative implications of this result, and they show that a realistic calibration does help address exchange rate puzzles, and they also provide additional exercises to have a kind of unique interpretation of quantitative easing. All right, so there's a lot more in the paper that's not just this simple static model, of course. All right, on to my comments. The first comment I want to make is just trying to understand a little bit more about what this convenience yield captures. And like I mentioned before, I've done a little bit of work in this area. I have this paper with Gordon Liao thinking about how currency hedging across countries affects convenience yields, exchange rate movements, and how that all ties together with global imbalances. So unfortunately, because it's fresh in my mind, a lot of my discussion is going to draw a little bit on that paper. In the first comment, there's a useful equation that we've derived in our paper, which tries to get at the heart of like what does a cross-currency basis ultimately measure. In this paper, the convenience yield is proportional to countries' cross-currency basis, or more generally, an average of currency bases across the G10 currencies. All right. In this paper I have with Gordon, we show that a currency basis can be pretty much thought of as a combination of two factors. There are currency basis is going to depend on intermediary constraints, which you can kind of think of like as how hard is it to supply dollars in foreign and spot markets? Okay, what are the constraints to supplying dollars in foreign and spot markets? And it's also going to depend on the demand for currency in foreign and spot markets. So in our paper, we're thinking about the demand for currencies forward. When you see movements in the currency basis, that's going to be some combination of movements in intermediary constraints over time, and also some combination of movements in like in the demand for the currency in the markets. Now, a large part of the early literature started off by focusing on this supply component here, right? You want to think really hard about what are these changes in the difficulty it is to supply dollars. In this paper I have with Gordon, we're thinking primarily about the combination of this demand component here. Okay, what are the changes in demand for dollars over time? And if I want to think about convenience yield as capturing something about demand for liquidity and safety properties of US dollar, I think a useful way of thinking about this might be to think about a model where we ultimately end up with an equation like this, where a US Treasury basis is some combination of how hard it is to supply dollars, so intermediate constraints, multiplied by something that tries to capture this demand for US safety and liquidity. Now, you'll notice I didn't stick like convenience yield here on the right-hand side, because this isn't the convenience yield. The convenience yield is basically this US Treasury basis multiplied by a factor. It's proportional to this usual US Treasury basis. However, if you stare at this equation a little bit, it tells you that when you see changes in convenience yields, you're really seeing kind of like a change in like an amalgam of forces. You're seeing changes in these intermediary constraints, the supply side, as well as you're seeing changes in demand for the safety premium, something coming from the demand side. And also you might be seeing other forces that may affect the demand side, like hedging demands over time. I think staring at an equation like this is really useful for clarifying what exactly is going on, maybe when we see changes in convenience yields over time. I understand that separating these various motives is hard. We've gotten asked about it as well for our paper, but again, it's as if any kind of progress that the authors can make towards here, maybe also trying to calibrate some of this intermediary constraint changes over time, I think would be very useful in getting more people to understand exactly how to think about the stochastic properties of convenience yields and what they're trying to capture. Okay. There's two other things I learned from writing this other paper that I think are relevant to an understanding of convenience yield. One is that convenience yields can vary dramatically across countries, all right, or cross-currency bases vary dramatically across countries. And so if you take this idea that convenience yields are proportional to currency bases, naturally you're going to say that convenience yields are varying dramatically across countries, essentially reflecting that some countries are going to demand more dollars than others. The other thing that I learned is that these differences in convenience yields can reflect differences in net foreign asset imbalances. So this left-hand side is a figure that we have in our paper that kind of plots countries' average cross-currency bases over the last 20 years against their net foreign asset imbalance. And you can see that some countries over here, Australia and New Zealand, they have negative imbalances. Well, they also have this persistently positive currency basis, or what we would call a negative dollar convenience yield. Countries like Japan and Switzerland, they have these large positive dollar imbalances. They also have these large positive convenience yields, or you're going to observe positive convenience yields. So that leads to my second question. I wonder if the authors can do a little bit more to think a little bit more about the cross-section. Overall, should I think about this model as something about the US versus the rest of the world, or simply a model of the US versus another country? For me personally, I think this convenience yield is a very convenient way of thinking about some average desire to hold dollars. So that's a story of the former, the US versus the rest of the world. However, there is indeed large variation in time series averages of currency bases over time. And so, it would be helpful to clarify, one, whether there's something special about calibrating these wedges to just the US Treasury basis, or maybe the theory is more general and we can calibrate to other currency bases and then use that to try to explain a full cross-section of currency risk premium. The other thing I learned, right, is that these currency bases, they are related to countries' external imbalances. There's a tight link between these foreign imbalances, exchange rate behavior, and currency bases. So, this current paper focuses primarily on asset pricing puzzles. I'm wondering if the same kind of framework can be extended now to also think about changes in quantities. So perhaps the flow of investment into the U.S. over time. I think there's like a lot of opportunity here to tie together some of the forces that we see, or some of the questions that we see in the international macro literature as a whole. Okay, I want to end with quantitative easing. Essentially, this current exercise estimates this impulse response function of exchange rates to a lambda t to a convenience yield shock. To me, this doesn't necessarily seem specific to quantitative easing, because any kind of shocks to dollar convenience yield is likely to have some impact on these exchange rates. So I'm wondering if perhaps the authors can also, expand this section to say something more generally about monetary policy. I'm sure like when the Federal Reserve does other types of monetary policy actions, that there's going to be some effect on the dollar convenience yield, and then that would also affect something about that would also affect exchange rates as well. So I think this part of the paper can really be broadened to say more about policy as a whole. There you go. Okay, so let me conclude. I'm out of time. Basically, I think this paper does a great job of showing the relevance of the convenience yield quantitatively, right, to explain these asset pricing puzzles. I'm really hoping that maybe the author can do a little bit more to clarify what is going on in the convenience yield, and also maybe expand a bit further along this research agenda, tackle other types of macro finance puzzles. Thank you very much.
Thanks, Tony. Thanks for that great discussion. Before I turn to the authors, maybe I can give Karen Phil. But shall we just collect a couple of questions, Hannah, before we turn to you?
Yeah, that sounds great.
Okay, so let's go to Karen Phil. I see that Dimitri has his hand up as well, so let's go in that sequence.
Do you hear me well?
Yes.
So I had a question about the term structure of this convenience yield. So the way I understood it, in your model, lambda is kind of the instantaneous convenience yield. But I wonder, so have you tried exploiting this term structure of 1 year versus 5 years, for example, convenience yield? Because when you have QE that is influencing the long term of the yield curve, presumably the long-term convenience yield would react more strongly than the short-term and the mid-term one. And then the second question is actually, it was addressed by the discussant. So I also had a question: if you look at the cross-section of this basis for different currencies, do you see different convenience yields for the different currencies?
Yeah, just building a little bit on some of the comments that Tony made. So somehow the origin of the convenience yield, and if we think of it as kind of relating a bit to safety, kind of one way to take this part out is to look at interest rate swaps, and instead of looking at government bond yields. And I was just wondering what kind of views you have. I'm sure that this is a question that has come up many times in the discussion of convenience yields. And anyway, what's your view on that? I mean, if we had interest rate swaps instead of government bond yields, would we get similar kind of asset pricing effects? What would your theory imply about that, etc.?
Okay, Hanno, so a lot of questions. I think, just looking back to the previous paper, the role of intermediaries, I think, is looming large here. The cross-section across currencies. I guess it's also relevant for Dimitri's question about, what is the right interest rate here? Is it something that's relevant to the intermediary sector, or is it through the treasuries? So over to you.
Hey, great. Well, great questions. Thanks for a really good discussion, Tony. So let me address the first question: maturity structure. We in fact in the paper report a table. I didn't get to show it, where we do exactly what you're suggesting, which is we look at the basis in government bond markets at different maturities. And what you see is that the response of the dollar exchange rate to shocks to the basis around QE events is consistently negative and significantly so, even when controlling for interest rates. But it's a bit stronger at the short end of the maturity spectrum, actually. So but you do see consistent effects across the whole spectrum of bases. So we look at 1 year, 2 year, 5 year, and 10 year, if my memory serves me right. So I'm going to direct you to the paper for the details. But yeah, we have done that exercise. You're right that our model doesn't really at this stage allow us to think more about that maturity structure. To the second question, Dimitri's question, and I guess also related to Jung's question, I think this is actually kind of an important point to touch upon. So what is the relevant basis to look at for our channel? So as you know, we look at CIP deviations in government bond markets, and to us, this is not to be interpreted as an arbitrage opportunity. The marginal foreign investor is perfectly happy with a much lower return on a long position in US dollar denominated bonds because she thinks that compensates her in other ways, safety, liquidity. We don't microfound this, but that's really at the heart of our thinking. And what I want to point out here is that this by no means sort of crowds out these other interpretations of, for example, bases in LIBOR markets that have been documented by many others, including Wenjin and Adrian, where they refer to binding constraints faced by financial intermediaries. So there's actually, I think, these are not substitutes, these two views. You're just looking at a different first order condition. In that literature, you're looking at the first order condition of financial intermediaries who are arbitraging in money markets across different currencies, and those constraints may or may not bind. What we're looking at is a different first order condition of an investor who likes the safety and liquidity of dollar bonds. And in fact, what you see is that even before the great financial crisis, there were large cross-currency bases in government bond markets. So these deviations that we look at, they were there even before the great financial crisis, consistent with the idea that this is sort of, in that sense, a different phenomenon. It's related to bases in LIBOR markets, but it is different. And in fact, we went back for the UK and the US all the way to the 70s, and we document really large deviations in CIP in government bond markets. And these are obviously not related to sort of the standard financial intermediary constraints that people have talked about. So that's I think I'm glad both Dimitri and you raised this issue. This is probably something I should have been clear about in the presentation. We're just looking at a different first order condition. I think that's the short answer. But this is an important point. And so our point is that the safety and liquidity of dollar-denominated assets is going to be priced into the dollar. Now, it could be that if you look at the first order conditions of financial intermediaries, you also come up with interesting implications for the dollar. That's not what we do, though, in this paper. And that's not the channel that we're interested in. Perhaps Arvind wants to weigh in here, or Zhen Yang, because I think this is an important point. So I want to give my co-authors an opportunity to weigh in as well.
Yeah, Arvind, Zhen Yang?
Just to build on that, on what Hanno just said, you can think about the convenience yield in one of two ways. Some investors are overpaying for some dollar bonds, and their first order condition tells you something about co-movements between their willingness to overpay, the convenience yield, the price, and exchange rates, and these puzzles that we're addressing here. Another way of thinking about it is, might be some investors who don't actually get convenience or lose convenience from supplying it. So a intermediary can issue dollar bonds and harvest some of that convenience yield. What prevents them from doing that? It's their leverage constraint, for example. That's the channel that people have explored. And so you can also understand it as the supplier marginal cost is relevant, and it turns out both are useful for thinking about exchange rates. But as we make clear, we're kind of looking at it from the investor who really wants to buy dollar bonds and understand how that thinks about exchange rates. And just to say one more thing, or Hanno, do you want to jump in?
No, I just wanted to add that I guess the key difference is that the Treasury doesn't actively try and narrow the CIP deviation in government bond markets by, for example, supplying more treasuries when the basis is large, right? So that's a key difference between the basis we're looking at and, say, looking at a more conventional LIBOR type basis, because there, obviously, banks, if they're not constrained, are going to try and narrow that gap. Yeah, sorry.
No, that's exactly right. And that in that sense, and as Hanna said, it's broader, it seems, than looking at the LIBOR basis. It must be related to quantities as well. You know, we're running exercises and we're looking prices and prices. There must be a footprint of this in quantities, and that was very nicely illustrated in the picture that Tony showed. And there is definitely more room to understand this. Which among their set of world investors are the ones who are pushing this? Is it investors from certain countries? Is it certain types of institutions? Foreign exchange reserve managers, foreign mutual funds? There's a lot more texture that can be gained by understanding quantities and understanding which of these guys around the world are pushing the stuff. I think that might connect with this cross section as well that Tony put up, and that's certainly something that is well worth exploring, that I think should be on all of our collective agendas.
Indeed. So we did actually leave a little bit of a padding for the next session, but I've just let it run. So I think we still have a couple of, well, we have 1 minute left. Zhengyang, do you want to come in here? Is it okay?
Hear me?
Yeah.
Okay. I think the question regarding which interest rate to use and intermediary constraints are well clarified by Hanno and Arvind. I just want to respond to the first question a bit more. I think that's an interesting question. How do we think about or model the term structure of convenience yields? And here's our take, at least in the current version of the paper. So we are kind of thinking about the convenience yield as following an AR1 model, and we pursue the whole term structure implication on the government bonds convenience yield across the maturity spectrum following the AR1 model. We think to the first order, this is a reasonable way to think about convenience yields because it does die down over a few months to a few years' time. But it is, of course, possible to explore other structures of the convenience yield shocks, and that could, of course, lead to different term structure. But we think that's a good start. And in this paper, we're considering this simple model to get closed form solutions in relation to the exchange rate puzzles. Thanks.
Great, thanks a lot. So that's so this has been a great session. I think so Hanna, you've given us a lot of food for thought, because I think this is going to be one of the enduring themes this year as well. I mean, we're going to really test the convenience yield hypothesis in the months ahead. And I think right. The long end of the curve, I think that's going to be a really important topic for us, because I think it's much less obvious there.
Right.
Yeah.
Yes. And I think we're seeing some interesting changes right now at the long end. I think if you look at the measure that Wenjin and Jesse back out from the cross-currency basis swaps there, it looks like at the long end, the convenience yields on treasuries are gone. So it looks like there's something that's changed there. Yeah.
Yeah. I think this is also related to Daryl's point about are they really the safe benchmark? Anyway, very good point to turn to the last paper. But the last paper. So Pierre-Olivier, can you take the ball? So the last paper is on. So this is joint with Dimitri and Walker Ray on the preferred habitat model of term premium and spillovers and currencies. Over to you.
Well, thank you. You should be able to see my slides. But I think you have to mute yourself so that I take over.
Then I think what we need to do, Pierre-Olivier, so I think WebEx is still behind Zoom. So what I suggest everyone do is on the layout, go to the stack or focus format. Then we can see the full screen.
Yeah, thank you, Yuna. And I think if you also mute yourself, that will be that will give me the sort of the screen. But let me know if that that is not working. Okay, so that's good. So thank you very much for putting the paper on the program. This is joint work with Walker Ray at LSE and Dimitri, also at the LSE. And here, what we do in this paper is we try to go back at what we view as a fairly large question in international macroeconomics and finance, which is the question of how monetary policy, both conventional and unconventional, transmits domestically and internationally. And if we think about sort of especially about the international dimension, if we think about the off-the-shelf open economy macro models, I would argue that the transmission there is very, the models we have are quite contrived. And here I'm sort of going to caricature a little bit some of this literature, but I would say, you know, if you look at this standard macro models, there is very little role for time-varying risk premia in this kind of models. I mean, in fact, in many cases, they are log linearized, and so at the first order risk premia are constant. And some form of the expectation hypothesis in the term structure and uncovered interest parity condition are going to hold. And this has very important implications for the way monetary policy in one country is going to transmit both in that country and in the rest of the world. So for instance, the expectation hypothesis tells you that the yield curve in each country is going to be entirely controlled by the local policy rate. If you move the short end, the policy rate, that's going to affect the yields at all maturities. And that's the only thing that's going to affect the yields at all maturities. And UIP is telling you that the exchange rate is going to have this very important role as a shock absorber, and it's going to absorb any deviation between the policy rate in the home country and the foreign country. And in fact, it's because the policy rates also affect the term structure in each of the countries. The exchange rate is also going to absorb any deviation between yields in the home country and the foreign country at any maturity. It's going to insulate the term structure in both countries from one another. And so this is a very sort of strong form of what you might call the Mendelian insulation, if you want. And a direct implication of this is that things like QE or foreign exchange interventions will have no effect, whether at home or abroad, because, you know, the policy rates are not changing, then pretty much nothing changes. Quantities don't play a role. Now, there are a lot of reasons to be quite doubtful about that very sort of caricature of the open economy macro models we have. One is that we have evidence of time-varying risk premia in currency markets. If we think about the FAMA puzzle, a lot of the papers presented in the session today were touching upon that, or violations of expectation hypothesis in the bond markets. Second, the currency and the bond risk premia appear to be quite connected. And there is recent empirical work, some of which has been done by Anno and co-authors, but also papers by Lloyd and Marine and others, that establishes the extent to which the term structure and exchange rates are sort of, and bond risk and currency risk premia are tied together. And then third, we have mounting evidence and convincing evidence that unconventional monetary policy or foreign exchange interventions do have effects both at home and potentially across countries. Now, on the theory side, and here I don't have to sort of dwell too much on this, I can just refer to Hanno's presentation just in the previous paper. We know that sort of the standard representative agent, no arbitrage model without frictions is going to have a hard time explaining many of the empirical facts. And the recent literature has been emphasizing various forms of frictions and limits to arbitrage that might play a role, whether they're on the side of intermediaries or whether they're in the form of the kind of wedges that Hanno and Arvind and Zheng Yang have presented. Okay, and so what we're going to do in this paper is sort of following that line of research and introduce a global rate arbitrager that is able to invest in fixed income in home and foreign country, and also in the currency market. So you can think of this as a global hedge fund or a fixed income desk of a broker-dealer or multinational corporations or even central banks that are actively investing in those markets and arbitraging to some extent there. And so formally, we're going to build that as sort of an open economy extension of the very important earlier work that Dimitri has done with Villa in the closed economy context. And so we're going to build from a preferred habitat model. I should mention that there is a contemporaneous paper by Robin, Sam, Jeremy, and Adi that covers very related questions with a slightly different way of modeling them and so focused on slightly different questions. But there's another paper out there that is exploring very similar issues. Now, what I'm going to show in the time I have is that we can, with that setup, we can reproduce qualitatively a number of facts about bond and currency risk premia. So there's sort of a finance side to the paper. We ask, well, can we understand some of the empirical puzzles out there? Can we make progress on this? And the answer will be yes. And there's a macro side also, which is that when markets are segmented in the way we model them, then there's going to be a much richer array of possible transmission of monetary policy shocks, both conventional and unconventional, via exchange rate and term premia. And so that's going to give us also a sense of the kind of world we're living in which policy changes in one country may also ripple through and affect monetary conditions broadly in other countries. And so the general message that's going to emerge from this exercise is that we have sort of a failure of the trilemma, or the Friedman-Upsell-Taylor's trilemma, in which exchange rate can sort of isolate countries and buffer them from monetary conditions in other countries. Here, that's not going to be the case, even when exchange rates are flexible. And so floating exchange rates provide limited insulation in the framework we're going to present. Now, it's a framework that is fairly rich. It could potentially be used to answer more ambitious questions. We're not there yet, but things like, well, what about the macro side? I'm going to present something that is sort of still partial equilibrium, focusing not only on the financial sector, the bond markets and the currency markets. You could think about plunging that into also more traditional macro models, but we're not there yet. You could think also of adding additional frictions, things that would generate deviations from CIP of the kind that were discussed earlier today, or variations from the lower fund price, but also that's not something that we're going to have. So let me sort of start with the setup here, and briefly I'm going to present sort of the general setup, and I'm going to specialize it to simpler cases where we can sort of get the intuition going as to what's going on here in this environment, and then I'm going to show you a sort of a calibrated exercise where we estimate the model on a set of empirical moments, and we can sort of try to put some flesh on the bones here and see how far we can go quantitatively also in explaining some of these puzzles. So this is going to be a continuous time model with two countries, home and foreign. The nominal exchange rate E here is going to be the home price of the foreign currency, so an increase in E is a depreciation of home's currency. And we're going to have a continuum of zero coupon bonds in zero net supply in each of these countries. And there's going to have some maturities between 0 and some cap T that could be any number. Okay, the bond prices for a bond in country J at time T with a maturity tau is going to be noted by this object here, PJT of tau. And the yield to maturity is just going to be defined as the negative of the log of that bond price divided by the maturity. Now, if you take the limit of this yields to maturity towards 0, this object here, this IJT, this is going to be the short policy rate, which we're going to assume is sort of set outside the model. So think about maybe a central bank that is out there in country J that is setting the policy rate for whatever reason. Maybe it's following a Taylor rule, maybe it's following some other rule, and it's sort of able to set this policy rate in the home country, and the foreign country is also another central bank that is doing the same thing. So these policy rates here are going to be following exogenous processes, which we model in continuous time according to the equation you have at the bottom of the slide. And these BIJT are going to be sort of two of the shocks we have in the model. And you can think of them as sort of conventional monetary policy shocks. Okay. Obviously, since I'm telling you there is a shock to the policy rate in the home country and another shock to the policy rate in the foreign country, I'm already assuming that exchange rates are floating and are sort of able to sort of adjust in any way that sort of satisfies first order conditions and market clearing conditions. Now, we're going to have three types of investors in this environment. And the three types of investors are going to be the following. First, we're going to have this preferred habitat bond investors. So what are these investors? Well, they're investors sort of located on the home term structure, on the foreign term structure, and they only demand bonds of a specific country and a specific maturity. Okay, and so that's the one class of investors here, which is proxying for very passive investors, or sort of have a mandate that restricts them from investing in all the different segments of the market. So you can think of, maybe life insurance companies that are mandated to stay within domestic bonds, or in the long end of the term structure, or maybe some other agents are sort of located on the short part of the term structure. We're going to take this idea and push it to the limit by assuming that you have these investors that are just buying one maturity of one country. Okay. Then in addition, we're going to have currency traders that also have preferred habitats. So think of these as agents are just in the currency market. They're buying and selling domestic for foreign currency. You can think of this as resulting maybe from orders that originate from the real side of the economy, exporters and importers that need to obtain foreign exchange. Or you can think of this as just any other class of investors that could be investing in this market. They could be invested both in the spot market, or they could be also investing in the forward market. In our environment, this doesn't make really much of a difference because CIP is holding, so you can think of a forward as a combination of a spot transaction and two accompanying home and foreign bond transactions of a given maturity. Okay, and so that sort of completely collapses out. And then all of the sort of interesting things that are going to happen in the model are going to happen because of this global rate arbitrager that we're assuming here. That global rate arbitrager is going to be able to crawl on the domestic and the foreign term structure, and also to go in the home and the foreign country. And so that is going to arbitrage between any sort of price deviations that are able to spot, but there are going to be limits to this arbitrage. These global rate arbitragers are going to be risk averse, and they will have finite resources. Okay, so I'm going to start by focusing on this global rate arbitrager and show you what optimization program they are trying to solve. And so here I'm going to introduce a little bit more notation. WT is going to be the wealth of this arbitragers, which we're going to denote in the home currency. And WFT is going to be the wealth that is going to be invested by this global rate arbitrager in foreign currency, the total wealth invested in foreign currency. While XJT of tau here is going to be the amounts that's invested in country J maturity tau bonds, again measured in the home currency. So if these are foreign bonds, then we're measuring that in terms of the home currency. And this global rate arbitrager is going to solve a fairly simple mean variance optimization problem, which we could derive as the limit of Noelji model. It's very simple because the mean variance part is going to eliminate any sort of dynamic hedging components. It's going to give us a very, very tractable portfolio allocation here, and it maximizes basically expected change in wealth minus a variance term here, and an important parameter is going to be the risk aversion A of this global rate arbitrage. Now, the law of motion for the wealth of this global rate arbitrager is fairly simple, and I'm just writing it so that you can see the different bits that go into the portfolio here. You could think of everything being invested in the short domestic rate and earning the policy rate IHT here, and then the part that's investing in foreign currency earns an excess return that's related to the excess return coming from the currency carry trade. You're investing in a foreign currency, you're taking the currency risk, and you're earning some expected return relative to the home to the home interest rate. So you can think of this as some currency carry trade return. Then there's a part that's invested in long-term bonds at home, and that part earns whatever is the excess return on the long bonds relative to the policy rate. So that's the bond carry trade at home, of course, multiplied by the size of the positions that you have in these different bonds. And then the same thing for the foreign long-term bonds. And so that's like a bond carry trade in the foreign country. Everything is measured in the domestic currency in this equation. Okay, so now with this in place, let me also tell you how the preferred habitat investors are going to be operating in this environment. And here we're going to make a very simple assumption. We're going to say, look, these guys are going to be price elastic, but they're also going to face some shocks to the demand that they have. And so think about the demand for a bond of maturity tau in country J. This is the ZJT of tau. That's sort of the position that these preferred habitat investors want to hold at time t. And we're going to say it's going to be price elastic. So this first term here is telling you that if the price of those bonds is rising, then these preferred habitat investors choose to reduce their holdings in that maturity. And then there's a second component with this beta JT, which is just a shock to the demand that's coming from this preferred habitat. And with the notation we have here, an increase in beta is like a reduction in the demand for bonds of maturity tau. Okay, and so this change in betas here, these demand shocks, are going to be one of the ways we can think of something like non-conventional monetary policy, which would be, think about the central bank, for instance, buying long-term bonds in a home country. That would reduce the net supply that's available for the global rate arbitrageurs. That would be like a decrease in the beta. And we're going to assume the same thing on the currency market. The currency preferred habitat traders are going to have a demand for currency that is price elastic. So it depends on the log of the exchange rate here with some elasticity alpha E. And then there's some currency demand factor here, gamma T, that is comes on top of it. Okay. Now we've chosen this particular demand equations in part because we think they capture some interesting economic mechanism, but also because they give us a lot of tractability. Okay. So these factors here, the shocks to the demand for bonds, home and foreign, and the shock to the demand for currency are going to be three additional sources of fluctuations in this model, in addition to the short policy rates in a home and foreign country. Now, a key insight that you're going to see time and again in the time I have left is that it's the interaction between sort of the risk-averse global rate arbitrageurs and the price elastic habitat traders that is going to generate interesting dynamics. Why do I say this? Well, because if you're going to have a change in prices in this world, that change in price is going to lead to a change in the demand by the habitat investors according to the slope of their demand curve. That's their that depends on the elasticity of their demand. And as a result, global rate arbitrageurs in equilibrium are going to have to step in and take the other side of that trade, but they're risk averse, so they're going to require compensation in the form of an excess return for doing that. And so that's going to yield a link between shocks to demand or shocks to the policy rates and changes in risk premia and equilibrium. Okay, and I'm going to flesh that inside out in a minute. Now, market clearing is going to take a very simple form. In each of the maturities and each of the markets, the sum of the positions by the global rate arbitrageurs and the habitat investors is to sum to zero. The bonds are in near zero net supply. So, effectively, the Z's here also include any sort of net issuance by the fiscal authorities, if you want. And then the currency market has to also clear into the demand for currency by the currency traders and the global rate arbitrageurs to sum to zero. Let me start by sort of showing you what happens in the very simple setup where we sort of make the arbitrageurs risk neutral. If we do this, then basically the arbitrageurs are going to come in and take any position as soon as they spot any arbitrage opportunity. And so in this environment, regardless of what the habitat investors are doing, you're going to obtain UIP on the currency market and the expectation hypothesis on the bond markets. So immediately what it tells you is that the yields or the expected return on the foreign and the home bonds are only going to be tied to the respective policy rates. So the term structure is all going to be entirely driven by what happens to the policy rate at home for the home term structure and what happens to the policy rate in the foreign country for the foreign term structure. Okay. Now, UIP is also going to hold, and what that tells you is that the exchange rate is going to absorb any difference between the home and the foreign policy rates. And the exchange rate itself is going to be determined as a function of the home and foreign nominal interest rates. There's this kappa here is reflecting the persistence of these interest rate innovations. And so the more persistent is this change in the policy rate, the more it's going to have an impact on the exchange rate. Okay, so this is the world of the Mendelian installation I described earlier. The exchange rate absorbs any difference between home and foreign. The home monetary authority is able to set the policy rate the way they want at home, completely controls the term structure at home, completely insulated from the foreign term structure. Okay, that's not a very interesting, very exciting world. So let's make it more interesting. So I'm going now to present what happens if we have a segmented market where instead of having just one global rate arbitrager, I'm going to introduce 3 different arbitragers, one on the home bond market, one on the currency market, and one on the foreign bond. Each of these arbitragers are going to be sort of, all of them are going to see the home and the foreign policy rate, but they're not going to be able, the foreign exchange arbitrager are not going to be able to take long positions. The home bond arbitragers are not going to be able to go in the foreign market, let's say. Why do I show you this model? It's a sort of very strong form of segmentation here, because it allows us to build the intuition for what we're going to see in sort of the full model. So then we get 2 results here in this segmented model. The first one is on the currency market. With segmented arbitrage, we're now going to get currency carry trade and UIP deviations as soon as the global rate arbitrager is risk averse and there's some price elasticity of currency demand. Okay. Now, what's the intuition here? Well, it's a very similar intuition to the Gebex and Maggiore 2015 paper. Suppose that there is an increase in the foreign policy rate. Okay, so then there's the demand for currency carry trade, meaning investing in a foreign currency and shorting the home currency is going to increase. And that's going to tend to lead to an appreciation of the foreign currency with our notation that's an increase in ET. Now, as the exchange rate increases, since currency traders are price elastic, they are going to reduce their demand for currency. Foreign currency is more expensive, they want to hold less of it. As a result, the currency arbitragers in equilibrium, the holdings have to increase, the market has to clear, but for this to happen, they need to be compensated with a higher expected return on the foreign currency. And that a higher expected return on foreign currency is what's going to give you a deviation from UIP. Okay? You have a very similar mechanism taking place along the domestic or the foreign term structure. So now, as long as currency carry trade, the global rate arbitrager is risk averse, and you have some price elasticity from the habitat bond investors, then we're going to get some deviations from the expectation hypothesis and some expected returns on the bond carry trade. Logic is very similar to Dimitri's earlier paper. Imagine that the policy rate in country J decreases, then arbitragers want to invest more in the bond carry trade. They want to go long in the long rates and they want to short the policy rate. What does it do? It pushes up the price of the long-term bonds. Bond investors are price elastic, so they reduce their holdings. Therefore, the arbitrager has to step in, increase their holding, which requires a higher expected return on the bond carry trade. Okay. Now, what are the macro implications of the segmented model? And the model is more complex. It has some deviations from the, we can maybe move in the direction of explaining financial puzzles, but we're not going to be able to say anything interesting about transmission. Why? Well, because in that world, it's still the case that what happens to the home policy rate is going to be completely segmented from what happens to the foreign policy rate. So QE at home might have an effect on the term structure at home, but it won't affect the foreign country. Foreign exchange intervention is going to move the exchange rate, but it's not going to have any effect on the bond markets. And why is that? Well, it's not because of a failure of the trilemma. It's because the model is very, very segmented. This segmentation here that does prevent this transmission. So let me now move on to the global case. So now we have a global rate arbitrager able to sort of crawl on the domestic and foreign term structure and move across currencies. Now we're going to get now something that is much more interesting. What do we get? Well, first, if I look at the bond prices in equilibrium, the bond prices in country J now are going to depend also on the policy rate in the other country in equilibrium. And we can show that in the model where we don't have demand shocks, we can actually prove that analytically. The exchange rate is still going to be a function of the short rate at home and abroad, but the coefficients here are going to be different from the UIP case, and there's going to be a lot of attenuation. Importantly here, so we're going to get, as in the segmented case, that you have deviations from UIP and you have deviation from the expectation hypothesis, but now we also have cross-country linkages. Whenever the currency is price elastic, then the foreign bond carry trade is going to respond to what happens in the home policy rate. Let me give you the intuition here, because that's sort of the core intuition for everything that happens in the model. Suppose that the home interest rate declines. As before, the global rate arbitrager is going to see this. Now the global rate arbitrager is going to say, look, I want to now invest in domestic long-term bonds, and I want to invest in foreign currency. I want to do the currency carry trade and the bond carry trade in the home country. That is going to depreciate the home currency. That's going to increase the amount that's invested in foreign currency by the global rate arbitrager. So now the global rate arbitrager is facing more exposure to the foreign policy rate. If there is a decrease in the foreign policy rate, the currency will the foreign currency will depreciate, and that will hurt the return for the global rate arbitrager. What does the global rate arbitrager want to do? Well, it's going to want to hedge that exposure to the foreign policy rate by investing more in the foreign long-term bonds, because foreign long-term bonds are going to experience a capital gain when there is a decrease in the foreign policy rate. And that's the key channel through which you have an impact of a change in policy rate at home on yields, long-term yields in the foreign country. Now we can show that you have sort of similar results when you have QE, non-conventional policies, also going to transmit across countries, and sterilize foreign exchange interventions. Now are going to move the exchange rate like before, but they're also going to move the home and the foreign yields again, because they're changing the currency exposure, and the global rate arbitrager is going to want to take offsetting positions in the home and foreign long-term bond markets. And so what are the open economy macro implications here? From a theory point of view, what we see here is that monetary policy, whether it's conventional or QE, can affect the yield in home country, but also in the foreign country, as well as the exchange rate. So there is transmission from the home policy rate to the foreign term structure, even if the foreign policy rate has remained unchanged. So there is imperfect insulation. And if you think that what matters for transmission to the real side of the world is not just the policy rate, but sort of some weighted average of yields along the term structure, then that means that you don't control directly or entirely what happens to the cost of funds for corporates or households just by controlling the short end of the term structure at home. It also implies that QE or foreign exchange interventions can affect monetary conditions in both countries and depreciate the currency. And so we have a failure of the classical trilemma. Now I'm running out of time, so I want to basically skip a few things and show you now a calibrated exercise where we bring in the demand shocks and the policy shocks and see how far we can get in explaining some of the empirical puzzles. So I'm going to take maybe a minute or a minute and a half to do that. So in that last part of the paper, which is the one that we've been spending a lot of time on recently because we've tried a number of different ways of doing things, we have 5 factors: the policy rates in a home and foreign country, and the bond demands in home and foreign, and the currency demand. So these are our 5 factors. And we're going to assume that they follow some sort of first order autoregressive process, which in general could be fairly complex, but we're going to narrow it down to almost a diagonal system where the autocorrelation here is going to be diagonal, and we're going to only allow some correlation in innovations to the short policy rate. So it's almost like an independent model, but we allow the policy rates to be correlated because there is a lot of evidence that they are in the data. We're going to obtain a solution that's affine in these factors in terms of the exchange rate and the price of the bonds, and we're going to sort of solve for this numerically. And then we're going to estimate the parameters of the model by matching a wide array of second moments on short rates, exchange rates, and long rates. So things like the variance of the policy rate or the variance of the change in the policy rate, the variance of the change in the exchange rate, or the covariance between the change in the exchange rate and the change in the short-term yields, and the variances of yields at all maturities or changes in yields at different maturities. So we have a set of something like more than a few hundred moments that we're going to try to match, and we have a relatively small set of parameters to estimate. One parameter we're not estimating, I'm going to come back to that, is the risk aversion. The model can be basically is invariant to the choice we can make in terms of matching these moments. You could have a world in which you have high risk aversion in small shocks, or small risk aversion in large shocks, and you would match the moments just as well in terms of the second moments. Now, this is giving you a sense of how well we're matching things here. The dots here are the data. So if you look at this top graph here, this is the standard deviation of the change in the yields along the domestic term structure as a function of maturity between 0 and 20 years. And you see in blue, this line here is the model, the estimated model. So those are targeted moments. You can see that for the home term structure, the foreign. You can see the levels. You can see the correlation between home and foreign. And the broad picture we have is we can reproduce these moments fairly well. There are areas where we don't do as well, but in general, we sort of match the general patterns we see in the data. Now, the model implies relatively strong deviations from the expectation hypothesis. The way we document this is by reproducing within the model things like the Feynman-Bliss regression or the Campbell-Schiller regression. This is what the data shows you. I should have mentioned where the empirical exercises for the US versus the Eurozone, where we're using yields on the German bunds to as a proxy for Eurozone bond returns. And so we find this is the data sort of coefficients on the Feynman-Bliss regression. This is what the dashed line here is what you would have under the expectation hypothesis. It would be a 0. And the model in blue here is sort of able to reproduce broadly the patterns we see in the data, both for Campbell-Schiller or for Feynman-Bliss. The model is doing okay, but not as well when we're looking at UIP deviations. Here I'm showing you Hanno's and Adrian's hybrid UIP regressions, where you're using the return on the short-term return on long-term bonds against the exchange rate change. And they have documented that you have this sort of term structure of UIP deviations. We find something that is not as strong as in the data, that is also decreasing, that sort of is built into the model. So that's looking pretty good. But if you're looking at sort of long horizon UIP of the form of Menzi and Chain, for instance, here the model is sort of doing less well than what you see in the data, or if you're looking at long horizon UIP level coefficient. So here on UIP, the results are a bit more nuanced. Last thing I'm going to show you, and I'll stop with that, is what happens if we have monetary policy shocks, conventional and non-conventional. So I'm going to show this to you in two figures. The first one here is showing you the response to a conventional monetary policy shock in the home country, the US. In blue is the impact on the term structure in the home country. And here we're calibrating the monetary policy shock so that it's a 25 basis points reduction in the short rate. And what you see is that the impacts sort of spread along the term structure here. Very limited transmission to the foreign country. So conventional monetary policy, one of the results we have is at the estimated coefficient, almost no transmission to the foreign term structure. And some depreciation of the exchange rate as would be expected, although quantitatively this is relatively small. What about QE? Well, here for QE, we need to provide some estimate of the risk aversion coefficient if we want to calibrate the size of the QE shock. And here the exercise is the following. We say, let's take a QE shock that represents 10% of GDP. To map this into a size of the shock, we say, okay, well, we have to have an assumption on the risk aversion coefficient. And we describe in the paper how we calibrate this. This slide here is for a coefficient that is equal to 10. One way to think about this is like a relative risk aversion of 2 and a wealth of the global rate arbitrageurs of about 5% of US GDP. And in that case, what you see is fairly large effects of QE on the home country, the US, but also fairly large effects on the foreign country. So what we find is that there's a big difference between the transmission of conventional monetary policy across countries versus non-conventional monetary policy. The latter has a lot more spillovers to the foreign term structure, and also in responses to the exchange rate that are comparable for that value of the exchange rate, comparable to the ones under conventional monetary policy. Okay, I will stop here. I apologize, I went a little bit over time. We have presented an integrated framework that tries to make sense of some of this empirical puzzle and enlighten us on the transmission of monetary policy, conventional and unconventional, internationally, when we have these models with segmented arbitrage. Thank you.
Thanks, Pierre-Olivier. So the discussant is Charles Engel. Charles?
Okay, let me see if I can do this now. What happened here? Wait, okay, here we go. I'm not doing this right. Okay, let me try to make it full screen. Okay, now, all right, so you can see it, hear me okay? Okay, well, thanks a lot for allowing me to discuss this paper. Whoops, I can't make my screen move. There you go. So I think it's an important and well-written paper, and it's going to be a big contribution to the understanding of international financial markets. I'm not going to spend very much time, or no time really, kind of going over what the model does. Except to say this. I mean, it builds a model of that explains foreign exchange and long-term bond risk premia. The paper calibrates the model and assesses it quantitatively. And it can reproduce the return predictability regression. So I just want to do two things here. Really, one is to make some comments to help sharpen the questions asked, and the other is to have some suggestions for future work. And my starting point really is to do a literature review, because I'm old guy now. So in the late 70s and early 80s, there was actually a big literature on portfolio choice in open economy models. It wasn't just Curry. A lot of people worked on that from following Merton's 73 paper. But my view is that the literature was pretty unsuccessful ultimately, and it kind of died out for three reasons. I mean, first of all, that it couldn't really account for the size of risk premium. And I'm talking about the international finance literature. It couldn't really account for the size of the risk premium. For example, the Fama regression implies that the variance of the risk premium should be bigger than the variance of the expected depreciation. It couldn't account for it unless you had really big levels of risk aversion, and it had a hard time accounting for co-movements. It really couldn't explain portfolio holdings well at all. For example, the home bias puzzle. And it was difficult to incorporate these portfolio choice models into realistic, say, new Keynesian macro models. People kept working on that anyway, or maybe it's a good thing they kept working on it, and there was some progress made. So there were papers, studies that kind of jacked up the risk premia, either by combining Epstein-Zinn preferences with the long-run risk, or having rare disasters. There was some progress in incorporating portfolio choice into kind of standard macro models. Here I'm thinking of like the Devereux-Sutherland approximation method. And there was some progress in building models of explaining actual portfolios. But in a sense, it still wasn't successful, because each bullet point was successful in what it was doing, but kind of not in the other two points. So, for example, the Devereux-Sutherland approach, you could put the portfolio choice in a standard macro model, but then it couldn't really explain the risk premia, or it was bad in actually explaining actual portfolios. So that's where we are. Now, where does this paper fit in? So I think it's a really plausible model of puzzles in bond returns and foreign exchange returns, and the relationship between those. So I think it's a promising revival of the portfolio choice approach. But in terms of the three things I just mentioned, well, I think it offers a nice explanation intuitively for some important puzzles, but I'm going to comment about the size of the risk premium, because I'm still skeptical about that. It's set up in a way that it's not going to explain portfolios. It's, you've got these preferred habitat investors. That's just exogenously given. There's a intermediary that we don't even know what country it's in. So it's going to be hard to
it's just not set up to explain portfolio holdings across countries. And then I would say the jury's still out about incorporating this into more realistic macro models. I mean, I know that Walker-Ray has as a closed economy New Keynesian model that's a nice step forward in incorporating this type of analysis. So how does the model differ from the previous unsuccessful literature? Well, the main thing is it got away from the assumption that you've got a representative agent maximizing the expected discounted value utility of consumption. So there are these preferred habitat borrowers, and then you've got mean variance optimizing financial intermediaries. This financial intermediary in the paper is related to the financial intermediary models of asset demand that are I think are very promising, but it's not really quite the same thing. I mean, there are no explicit balance sheet constraints on the intermediaries. Instead, they're kind of intuitively motivated as having some sort of limit to arbitrage, which will then imply a mean variance objective. So what's the contribution of the paper? Well, actually, I'm not going to answer that question, but what I want to say here is that I would focus a little bit differently than the paper does on the contribution, because my view is that, looking at the effects of, monetary policy, I think you get just out of a even simpler model than the one people tried to work on in the 70s and 80s. I mean, I think if you go back to just an old-fashioned, Tobin, Branson type of model where you just say, well, people have demands for assets and they're imperfect substitutes. I think even in a representative agent model, you get these effects of monetary policy changes. I mean, I didn't work through it step by step, but and so maybe I'm overclaiming here. But I think if you just wrote down a model where you put all the assets into a CES utility function and they were imperfect substitutes, you would get the implications for monetary policy. And I have an example here that I won't go through given the time limit. So if it were me, I would focus more on what the structure that the paper provides to these questions. So what happens if there are changes in global risk or in changes in the risk aversion of the intermediaries, which might mean the constraints faced by intermediaries, or what happens when there are changes in the second moments of returns. And then especially, I think the quantitative part of the paper is important, where they try to account for the asset pricing puzzles and other, the quantitative results. So the qualitative effects of monetary policy, I think, are kind of pretty straightforward once you assume assets are imperfect substitutes. Now, let me just make this comment about the size of the risk premium, and I've discussed this with Pierre Olivier before, but implicitly, the model assumes constant absolute risk aversion. I mean, that's what the mean variance optimization means. And that's a kind of a weird thing, constant absolute risk aversion. For one thing, it means, that the size of the risky portfolio doesn't change as the investor's wealth changes. Here I'm talking about the choices of the intermediary here, the mean variance optimization problem for the intermediary. So that's weird in itself. But I'm also worried about aggregation because, if this constant of absolute risk aversion A is a deep parameter, then the relative risk aversion is going to depend on the wealth of the intermediary. And for example, if they calibrate the model, they talk about, well, we got one intermediary with a certain amount of wealth. Well, if that intermediary split up into 10 different intermediaries with the same coefficient of relative risk aversion, they would be 10 times less risk averse in terms of, the same coefficient of absolute risk aversion, they would be 10 times less risk averse, and therefore hold a portfolio of risky assets that was 10 times as big. So I wonder, I'm sorry, I know this must be bad to hear me clearing my throat all the time. I apologize for that. But I wonder how hard it would be to change the objective to a mean variance in returns rather than changes in wealth, because then Lambda has the interpretation of a coefficient of relative risk aversion, and these aggregation problems don't arise. I also wonder about the modeling of these preferred habitat investors. And you know, what I wonder about is if I have a preference for a, you know, I'm going to need dollars in 1 year. I mean, what is the implication? How much am I giving up by foregoing buying an asset that matures in 11 months and then assuming the rollover risk for 1 month? I mean, how exactly risk averse am I acting? I mean, is there a way to assess this? I suggest here maybe looking at the Sharpe ratio of these preferred habitat investors. Although thinking about the last paper, I mean, I wonder if we could model these guys as having standard Euler equations, but with a wedge, and if that would then allow us to think about, you know, how crazy these guys are acting. I mean, you know, there's a footnote that says you can motivate it with infinitely risk-averse investors, but that really, you know, I mean, that really isn't going to make me very happy about whether we can account for the size of the risk premium. So both for the intermediaries and the preferred habitat investors, I wonder if we're just sweeping the problem under the table, that the models can't really account for the size of the risk premium. All right, so let me make several comments about future research. So one thing I would really like is for to have two different intermediaries, one who assesses returns in the home currency, as the current paper does, but also one who assesses returns in units of the foreign currency. Or in other words, they care, maybe, you know, in real terms, the home cares about consumption or returns in the home consumption basket, and the foreign intermediary in terms of the foreign consumption basket. I mean, I think that's what's kind of neat about international finance. I mean, regular finance, you kind of have heterogeneity because of different degrees of risk aversion, but in international finance, people don't even assess the returns the same. You know, for example, the dollar bond is riskless for the US investor, and the euro bond is riskless for the German investor. And they note this, they note in the paper that they don't do this, and they say it would be hard. And I just, you know, I think that would be a neat project to think about having that kind of setup. You know, second thing, and this is related to what Tony mentioned in his comments about the previous paper, is that, you know, there's a lot of interest in modeling of flows these days. This is really a model of, you know, stock asset demand. And in particular, I'm wondering if the model could incorporate some sort of slow adjustment of portfolios, maybe through just some, you know, cost of adjusting portfolios. Although I think kind of a neater, more interesting way to go would be to have intermediaries who face balance sheet constraints, but also who have liquid assets, and then assets that are less liquid. And if an expected profit opportunity arises, you would, you know, go to your liquid assets. But when you kind of run out of them, or when you're pushing the edges of the amount you want, then you wait, because you don't want to sell your other assets at fire sale prices. So this is a little bit related to the kind of phenomenon Wen-Shin Du was talking about yesterday. I actually think looking more at what happens at the zero lower bound is interesting, because I think that this would allow us, you know, to distinguish between different models, and in particular the effects of monetary policy. Because, you know, what's different at the zero lower bound is that when you ease monetary policy, you don't lower the return on the short-term asset. And I actually think that that's a kind of a natural experiment that could be exploited to look at more of the different implications of different setups. For example, you know, the slow portfolio adjustment models of Paquette and Van Wynkoop may have very different implications than this model. Actually, another natural experiment, which this paper doesn't take on at all, is the fact that you know, assets are not only distinguished by currencies, but by location of the issuer. So you know, I mean, we know that borrowers in many emerging markets borrow in dollars, and we know that the dollar return on dollar assets differs by the location of the borrower. And so it would be interesting to see whether you know, an extension of this model could account for that phenomenon. Is it just default risk? Is it a convenience yield, or is there some sort of preferred habitat explanation for that? Okay. Oh, I'm going fast. I didn't even think I would get to this slide, but I'm glad I did, because, I got to tell you, I'm actually skeptical about these stylized facts that we're always talking about in international finance, because I don't really think they're that robust. And I don't think they're that robust, especially to what's happened in the 2000s. For example, the FAMA puzzle has fallen apart completely in the 2000s. I mean, it's just not there. And on the other hand, the exchange rate, well, the puzzle was that it follows a random walk, but now the exchange rate, it seems like it might be stationary. I'm talking about the nominal exchange rate. So, it shouldn't be surprising that these puzzles arose, because in the first place, we kind of knew the FAMA regression was not a very robust thing anyway. I mean, it's been known for a long time that the coefficient in the FAMA regression really moved a lot over different samples, and more than really we should be comfortable with. And that has to do with the fact that the left-hand side variable is kind of really stationary, and the right, but volatile, and the right-hand side variable is nearly a unit root, but not very volatile. And on the other hand, these findings about longer-term returns are very sensitive to the size of the sample. And my experience has been that analytic corrections for small sample bias don't really do the job. So, I guess the question is, how much energy should we be investing in these puzzles, trying to explain these puzzles, when we're not really sure they exist? But moreover, the version of the paper, sorry, that was alarm telling me my time's up, but my version of the paper doesn't say how the part simulating the puzzles was done. But what I wonder is, can it account for this instability we see? And can it account for the fact that when the behavior of the exchange rates changed in the 2000s, and the behavior of interest rate changed in the 2000s, that the puzzles themselves changed? So that was my last comment. Again, though, I think this is a great paper. I'm glad that this whole portfolio balance approach is being revived, and I think it's going to stimulate a lot of thought. It doesn't answer all the questions, and my view is that that's great, because we can still stay employed. If it answered everything, we'd be out of a job. But it's a really wonderful start.
Thanks, Charles, for that great discussion. Olivia, I think we have a lot of questions for you. Maybe we can just take a minute to address John's question about the number of countries, and whether the arbitrage is going to be spread more thinly if you have more countries. I guess it's related to Charles's question about the preferences of your arbitrageurs as well. We have a comment in the chat about other ways of breaking free from the Mendelian implications. So any quick thoughts before I open it up?
Well, let me first thank Charles for a very rich discussion. Not surprising, Charles has such in-depth knowledge of all this literature, so it's really wonderful, and thank you. And I think a lot of the points raised are very relevant, and let me just say two things. And then maybe turn it to Dimitri in case he would like to come in and say a few things. Matching the moments of international finance. I should say that we do things before the ZLB and before the financial crisis. So we go some into the 2000s, but a lot of the data on which we estimate the model is over a period where I think there is little dispute that there was some of these empirical facts. Now, how relevant they are going forward, I think the verdict is still out, so I'm not going to say too much about this. A lot of very interesting suggestions on how to extend the framework and what kind of moments to sort of try to aim for. We have to digest all this. I'm not going to respond to this here. The question about which I think John's comment in the chat that echoes one of Charles's question about the in a world in which you have more countries and each arbitrator is becoming maybe smaller, and then Does it mean that there are sort of that there are less of these effects? And I think Charles was asking, well, if you make 10 arbitrages instead of one, and are these effects going away? I think those are all valid questions, but in a sense, I would want to, I would want to push back a little bit on this. The important aspect of the model that we want to take to the data is this notion of imperfect substitutability, as was pointed out, and this link between sort of shocks to demand and how they have to be absorbed by investors that have sort of capacity to take on those positions on their balance sheet, but need to be compensated for it. Maybe they are facing some frictions, and that's going to lead to some pricing differences. Obviously, many ways in which we could do this. That's another question I think that was in the chat. You could sort of put more frictions or more specific frictions, and that would also give you deviations from the Mundelian framework. You could put some of these balance sheet restrictions. But at the end of the day, the question is, well, if we just think about natural arbitrage, but the standard restrictions, which is you have some risk aversion and you have some wealth, how far can we go? And here, I would say the verdict is not completely out. We're still fiddling with the estimation of the model, but we're really kind of very pleasantly surprised by how far along we can go in matching both things that are on the finance side and sort of quantitatively the kind of responses we see when we look at impulse responses to monetary policy or impulse responses to QE. So, I almost want to make an as-if argument. Yes, of course, in the world, there are global rate arbitrageurs in dollars and are in sterling and in euros and in yen. And the fact that they look at returns differently makes things very complex in a way that we don't know how to solve right now. But I just want to point out that even in this sort of simplified setup, where the natural habitat guys only buy the 12 months and not the 11 months, and nothing will make them move to the 11 month, which is, of course, a restriction, a reduction of what's happening. But that's still capturing very simply and very tractably something that is there. And so we don't make the claim that this is the only way you can break the trilemma or the Mendelian insulation. We don't make the claim that you should take too literally the way we model the habitat investors or even the global rate arbitrager. But I want you to sort of think about how far we can go with that. And my claim is that we can actually close a number of those things. We don't get all of them. We don't get the portfolios, that's for sure. But we're getting much closer than we thought we would be in this setup. I'll let Dimitri come in if he wants to maybe provide some additional.
Dimitri.
Well, okay. First of all, I want to thank as well Charles for such a great discussion. It's very rich, as Pierre-Olivier said. It's sort of lots of stuff for us to digest and think about. And so. I guess, yeah, I think the portfolio balance comment is key. I think we have to think a bit harder, kind of exactly how we can help kind of advance that earlier literature. I mean, I think we do advance it in different ways, kind of, because we give a more precise kind of understanding about how all these quantity effects depend, kind of work based on these covariances between the different instruments and the persistence of different factors. So, which I think is a bit difficult to get in very kind of, I don't know, one-period models or very simple models. But we need to read more about these papers. Yeah, kind of a few points about the relative versus absolute risk aversion. So I think that's kind of probably something that is, certainly we cannot have variation in wealth. We cannot have wealth effects. If wealth becomes a state variable, the model just becomes non-linear and impossible to solve. I mean, we kind of that if we make this parameter A, we make it I don't know, 1 over WT, for example. So that then it's not possible to solve. But if we break the 1 arbitrageur to 10 arbitrageurs, we can accordingly kind of redefine A so that we get the kind of relative risk aversion stays the same. So yeah. Anyway, changing having only foreign arbitrageurs instead of only home arbitrageurs, I think that's something we can handle. Having both, again, might be too complicated, but I don't think kind of quantitatively, I don't think on substance we're going to get big differences. But anyway, there's lots of other things for us to think about, so let me not talk more, and we just need to absorb a bit more and think.
Thanks, Dimitri. Thanks, Pierre-Olivier. I don't see any hands. I just let me just come in and just congratulate you on this very nice paper. And I think it's in terms of this approach, and Pierre-Olivier knows as well. We've been writing about breaking free from the triple coincidence. We tend to think of international finance as just a grouping of islands, and so you have this everything is about the current account, the currency area is the same thing as the GDP boundary, and so on. And I think this is as Charles said in his discussion, the whole point about where does the arbitrageur live, right? That's a pretty important question, and our current fashion is to drill down. We're using much more micro data. I think there's also a case for drilling up, and I think both your paper and the paper by Ralph, drilling up I think has a lot of virtues, and it does I think also pose the question: what's the right unit of analysis, right? And my own view of this, I think we've also seen it in action in in some papers is that the balance sheet might be the right unit of analysis, and it's not the GDP boundary, and probably the currency probably matters more than the country itself, the jurisdiction. Anyway, so this has been an incredibly rich session. It's a great way to end the conference, and let me thank you all for staying in the course. So thanks for staying until the end. Just leaves falls on me to thank Dimitri and all our colleagues at the LSE. It's been a great collaboration. Let me thank also the chairs of the sessions. Great to see John Moore, Ian Martin, and my colleague Claudio Borio. Thanks to the chairs and the program committee. Thanks, Andreas, for holding it up here, and not least Anne Law, Wana Krenetchen. Is that the way you pronounce it, Wana? Okay, and of course not to forget all our colleagues in BIS meeting services. So they're our colleagues who really make everything work. So I hope you have learned as much as I have. And Paul Woolley's there as well. So Paul, great to have you. Great to have you part of this as part of this event. And as I was saying earlier, well, actually yesterday, it's great to see all my former colleagues at the LSE. So stay well. Hope to see you soon, and keep up the good work.